is live. That in itself is a very, very big difference. It causes different psychology. And live stream shopping is a very entertaining way of actually engaging someone else.
When you shop, actually, this live streaming video will continue. It will minimize into a corner, and you can buy the items and pay all on the same app. And after that, the live streaming screen will just enlarge by itself, and the promoter will come back to screen. So it's very convenient.
Taobao, one of China's biggest e-commerce platforms owned by tech giant Alibaba, added a live streaming function in early 2016. In the following years, other e-commerce and social platforms like JD and Douyin also integrated this feature.
开头的时候还是有很多的挑战的，对画面的这个流畅，然后是否能够很真实的去还原商品，它其实在这个上面是有很高的这个门槛跟技术的这个卡口在的。不管是我们的这个用户的接受度，还是商家的这个上手的这个难度都很高，但是这几年下来，基本上难点在不断被突破的。
Over $70 billion worth of goods was sold via live stream on Taobao in the year through March 2021. Latest surveys show that over 60% of live stream users in China were watching shopping shows, and over 65% of them shopped at least once via live stream. In 2020, live stream shopping got a huge boost during the pandemic, when millions of people were in lockdown and many retailers were pushed online.
People, during the lockdown, felt like there's a need for more social interactions. This live platform creates an interesting kind of environment that gives people the sense that I'm actually interacting with you. And then live stream shopping brings in a lot more variety of things that people could buy and satisfy, the sense of losing control, especially during the pandemic.
At the heart of this craze are the top influencers who have tens of millions of followers and sell products worth millions of dollars every night. They often use their star power to get bargains from retailers, which in turn boosts their own sales and influence.
So if you think about China's live streaming, you have to know the king and queen of the influencers. The queen of live streaming, Via, she is actually having the biggest viewership and the biggest sales volume for a long time on Taobao platform. She can sell everything from Gucci sunglasses, lipsticks, homes, and cars. One time she offered her followers to go on a Tesla ride with her, and she even, for once, sold a rocket launch in her live streaming room for 40 million yuan. 接下来我们真的要上火箭。The king will be Li Jiaqi, more widely known as Lipstick's brother. He used to be a cosmetic sales before he turned into live streaming e-commerce. And he knows a lot about the cosmetics. So he's the one that will actually put the lipsticks on himself when he's on the show.
Top live streamers like Via and Li Jiaqi have become celebrities in China and can earn millions of dollars a year. Although not everyone can be as popular, mid-ranking live streamers like Tiffany still earn a good income through sales commissions.
如果说单从收入方面来讲的话，那主播的收入是比普通的工作要高很多。但是呢，主播这个工作时刻对身体，包括对精神都有很大的一个考验的。就是每天需要集中精力，然后长达5-6个小时，这种状态是很累的。而且这5-6个小时的话，你是脑子是不停的，然后嘴巴是不停的，然后手也是不停的，眼睛也是不停的。像我们做主播，不是说单一的只做直播一件事情，然后还会有选品的一些工作，然后还会有一些其他的事情排在里面，其实是没有个人生活的。那我觉得增强粉丝影响力的话，不是说某一件事情。可能今天做了什么事情你就增大了影响力，而是每天不断的内容的输出，粉丝不断的可能对你的了解，慢慢的信任你。
没有芝麻酱的味道，如果吃不习惯的话就慎买。
A lot of successful live streamers are generally very good at communication. They're very good at articulating very simply what a product does, what a product doesn't do. In order for them to sell, they need to be trustworthy and appear trustworthy, and they need to show in some ways that they're authentic, right? So for Via and Li Jiaqi, they are able to articulate that quite a bit through their body language, through what they say. For example, Li Jiaqi will also sometimes say bad things about certain products, because to him there's his honest opinion, and sometimes people want to hear that. And so they seem very credible, they seem very trustworthy, and don't forget, they're also very entertaining and very interesting. If you're familiar with Li Jiaqi, he won a Guinness record for like the most lipstick applications to models in like 30 seconds. So if you're able to create a lot of buzz with interesting things that you do, people who may not want to buy lipsticks will also stream in just to watch what he does. And then from there, you might get hooked.
这就是一般女生出门的时候涂的口红的颜色。
Live streamers also use sales techniques such as limited time or supply. This sense of scarcity can often encourage viewers to buy.
The platform in itself creates and enhances some of these things, because you see it live. Something we call social proof has taken over, meaning that, hey, other people are interested, other people are joining in, other people want the same product. And they add it in the chat and they ask questions and they say, oh, I want this too. What happens then? It makes the whole product even more scarce.
But it's not just influencers. Local farmers, luxury brands, even mutual funds have also started their own live stream shows.
Working with very top-tier live streamers can be risky. It's not necessary that the benefits will end up with the brand. So we see company executives opening their own shows, and we see like P&G have their own sales room which runs shows every day as well. We also have like local governors in like small towns to sell their agricultural products. So the live streaming is definitely transformed the way product owners can think about how to reach their consumers, and it enables a lot of players to actually sell.
Live stream shopping is going global. Merchants in Southeast Asia have embraced this trend. And in the West, Amazon has upgraded its live streaming function, adding interactive features like chat rooms. Companies, including Google and Facebook, are also developing and investing in technologies to integrate video and e-commerce.
直播电商它其实已经开始成为主流，它未来的发展空间跟潜力都是巨大的。
接下来大家会越来越依赖这种购物方式，会变成一个比较日常化、比较规范化的这么一个趋势。
If you look at the numbers alone, their numbers alone, Li Jiaqi's numbers or Via's numbers, you know that they can sell and you know that they can generate revenue. Are they able to sustain it over a long period of time? It depends on how innovative they are at changing some of the things that they do.
But you can't expect consumers one day turn into virtual shopping for good. There will be the nature of us that crave to go into the store, to touch the goods and actually wear it and see how it looks like and walk around in that with our friends. And those things wouldn't be replaceable with live streaming.
Connection lost.
You could imagine that the oceans are actually the largest battery. We're storing huge amounts of energy in the oceans. The wave motion can be very deep. It can extend down several hundred meters. And once it gets to the near shore, from about 50 meters, the whole water column is moving backwards and forwards.
As we search for ways to reduce our reliance on fossil fuels, some are looking to a largely untapped potential source of renewable energy. In theory, waves off the coast of the United States alone could generate over 2 trillion kilowatt hours of electricity a year, enough to power more than half of the country.
Waves intensify and subside not as quickly as the wind, and that means that it can produce a smoother power generation curve. One of the potential advantages of wave energy is that it could act as a complementary source of power compared to other renewables on the grid if it were to be scaled up to commercial scale.
For decades, engineers have been trying to convert wave energy into electricity, but a host of technological and financial challenges have complicated their efforts.
In the years from around 2006 to 2015, there were a spate of bankruptcies in the sector, and this was largely because of a lack of kind of continuous proven projects out at sea with reliable electricity generation.
Since then, companies have been trying to develop the technologies at a steadier pace and with a smaller cash burn. But the same questions remain. Can companies develop devices and technologies that actually work? Is wave energy just a novelty or something that can become a major renewable energy source?
The sea is a very challenging environment within which to operate a power project. So seawater is corrosive and conditions are very rough. So this means that power projects don't have a very long lifetime, and it increases operating and maintenance costs.
Partly because of that, many early wave energy projects hit rough waters, such as the Palamas Wave Energy Converter in Portugal and the Isla Limpet project in Scotland. But that hasn't stopped others from trying.
Companies are focused on testing projects out at sea, proving their durability, trying to raise capital and bring down cost. The sector hasn't really converged around one single technology design, and companies are kind of undecided about which design works best.
Finland-based AW Energy is a veteran in the sector. The first proof of concept of the company's device was made in the 90s after diver Rauno Koivusaari observed the strong back-and-forth movement of a hatch cover in a shipwreck in the Baltic Sea.
The waves are generated far from the coastline, so the wind blows on the surface of the water, causing the water particles to rotate, and that rotation extends deep down below the surface, and the waves can be very long. They can be several hundred meters long. And as they come into the near shore, this rotational energy turns into an elliptical energy, and eventually backwards and forwards, as you probably noticed if you've been swimming on the seashore in large waves, you're pulled in and out. That's the energy that we're extracting. There's a sweet spot where we deploy, so around 10 to 15 meters of water depth. That's where there's still strong wave energy coming in.
After years of research, prototyping and testing, the company has deployed Wave Roller, a 350 kilowatt device in the waters off Portugal. Wave Roller has an 18-meter wide and 10-meter high steel panel fixed to the seabed via a floatable foundation. The panel moves back and forth with the waves, capturing the energy.
It's submerged in the depth of 15 meters, so it's protected from the extreme waves. We generate electricity by capturing the movement with hydraulic circuitry in a machine room underneath the surface. That hydraulic energy we turn to electricity with hydraulic accumulators and hydraulic motors, and also a generator.
The Wave Roller has survived large waves at sea for over a year and delivered electricity via an underwater cable to the grid in Portugal. Meanwhile, the company has won a €2.5 million grant to work on an upgraded version of the Wave Roller, aiming to increase the electricity generation capacity to 1 megawatt. The upscaled device would have a bigger panel, 2 power takeoff units, and improved software to control the energy production.
We have taken into use a wave prediction algorithm that kind of tells us what kind of waves are coming into our device. That gives us few seconds to prepare for capturing more energy, and the difference in that is significant.
Our future plans are to deliver technology around the world. So I'm hoping we can be working on delivering technology to projects in Asia and also in the American continent as well.
Meanwhile, Israeli company Eco Wave Power is taking a different approach to capturing the power of the ocean. For the company's founder, Inna Braverman, developing new sources of renewable energy is a personal mission.
I was born in Ukraine in 1986, and 2 weeks after I was born, the Chernobyl nuclear reactor exploded, causing the largest in history nuclear disaster. I was one of the babies that got hurt from the negative effects of such explosion. I had a respiratory arrest and a clinical death. Luckily, my mother, a nurse, approached my crib on time and gave me a mouth-to-mouth resuscitation, which saved my life. I got a second chance in life and decided to do something good with it.
Growing up, Inna wanted to be a politician to positively change the world. After working as a translator at a renewable energy company, she decided to change paths.
Solar and wind energy were fully commercialized. There were a lot of amazing technologies implemented everywhere. I saw that wave energy, although it's an immense source of electricity, the biggest companies in the world are trying to develop wave energy with no success. And there was kind of a race going on in the world of who is the company that is going to develop a viable wave energy solution first.
In 2011, the then 24-year-old Inna co-founded Eco Wave Power. Instead of installing devices offshore, the company's devices are attached to existing breakwaters, jetties, and piers.
Our technology is very cost efficient, especially in comparison to the offshore technologies, because we don't need any ships, divers, underwater mooring or cables. We install on existing man-made structures, and all our expensive equipment, the generator, the hydraulic conversion unit, the automation, is located on land just like a regular power station. This is the EcoWave Power conversion unit that has been operating in Jaffa Port since 2014 until 2020. Here you can see how the technology works. Basically, the floaters are going up and down and pushing the hydro cylinders, which transmit biodegradable fluid into land-located accumulators. A pressure is being built. The higher the waves, the higher the pressure, which is used to turn the hydro motor, which is turning the generators. The whole system is controlled by a smart automation system, which you can see right here. And in case of upcoming storms, the system automatically raises the floater above the water level and keeps them in the upward position until the storm passes.
The company has been operating a 100-kilowatt grid-connected device in Gibraltar since 2016, which is enough to power 100 households. Currently, Inna and her team are working on another 100-kilowatt project at the port of Jaffa in Tel Aviv.
The project will be also the first time in the history of Israel that wave energy will officially connect to the electrical grid. And our goal going forward is to expand it to all suitable breakwaters in the city of Tel Aviv and to supply a significant part of the city's electricity needs.
Today, engineers and entrepreneurs are still trying to crack wave energy. Globally, only a few hundred kilowatts of wave energy are deployed, compared with gigawatts of offshore wind. But the field has come a long way in recent years, and with the right engineering solutions, this new power source could eventually become competitive with more mature renewables like solar and wind.
I would have a lot more confidence in the success of wave energy companies today as opposed to like 20 years ago. But in the next few years, or maybe the next couple of decades, it will be more likely to be used in remote locations like islands that are otherwise dependent on expensive diesel power, or out at sea on gas decommissioning rigs, or for powering underwater autonomous vehicles.
So definitely, wave energy can compete with other renewable energy sources, but I personally believe that this is not a competition. In order to have a 100% renewable energy friendly world, we need all renewable energy sources to work together.
Who are all these people from? Who are all these people from?
So can you please tell me? I'm not going to... please wait.
You know, I've covered a lot of companies. I've covered a lot of Machiavellian companies where, you know, people play rough. I don't think I've ever seen anything on the scale of Nissan.
He is making you, but you aren't from this side. I mean, it's corrupt.
One of the most dramatic elements was Ravinder Passi's home being raided by court officials in Yokohama.
You scared my wife. You scared my children. I worked in this for 16 years.
So Rav Passi's journey into the darkest recesses of the Japanese corporate world started when he was the general counsel, the highest corporate lawyer position in the company.
In the past few minutes, Nissan has revealed that its chairman has been arrested after allegations of serious misconduct.
He was tasked with investigating Carlos Ghosn. And he was told, conduct an internal investigation and get to the heart of the matter. And then along the way, he started to notice serious conflicts of interest.
He is one of the few people who knows an extreme amount of detail regarding the alleged crimes by Carlos Ghosn. And he's now ready to tell his own story on the record about some of the events that happened.
My name is Ravinder Passi. I'm the former Global General Counsel of Nissan Motor Co. Limited. And you could say, yes, I had a front row seat in terms of what was going on.
When Carlos Ghosn saved Nissan years ago, he was depicted in Japanese comic books as this hero, and now maybe we'll see comic books where he's the villain.
In corporate Japan, Nissan was quite an unusual company. It was led for 2 decades by a non-Japanese executive.
Well, Carlos Ghosn was a hero in the Japanese business world. If you had a global business celebrity in Japan and worldwide, it was definitely Carlos Ghosn.
In a country with few foreigners at the top, he stood out. But over the years, he saved Nissan from bankruptcy, allied with Renault and Mitsubishi, and turned the alliance into one of the most competitive in the world.
Yet as the years went on, you know, I think his ambitions changed a little bit. He started thinking about legacy plays, and one of them was to really tighten the alliance between Renault and Japan. And unbeknownst to him, there was a contingent of senior Nissan executives that were really felt threatened by that move. They really thought that they would lose complete control of the car company, and even in the government, there was probably a little bit of anxiety about a national champion in the auto industry falling under full-blown foreign control.
Carlos Ghosn was an auto industry leader, respected by many in Japan. Now he's in jail.
The arrest of Carlos Ghosn came completely out of the blue. This was in November of 2018. He was coming to Japan on Nissan's corporate jet for a regular executive meeting, and he was met on the tarmac by Japanese authorities who whisked him away to jail and charged him with financial misconduct crimes.
So what happened was that a power struggle ensued inside the company, and somewhere along the way it was criminalized. By that I mean that there were allegations leveled at Carlos Ghosn about the way he reported his pay to Japanese authorities, the way he handled money inside the company, that in other contexts might have been a board action, might have been handled internally. A number of executives at Nissan decided to take this difference and take it over to the Tokyo prosecutor's office, and that unleashed a chain of events that would shake the entire auto industry.
So after Carlos Ghosn was arrested, Nissan launched an internal investigation into the events that led up to his arrest.
So Rav Pasi was tasked with investigating Carlos Ghosn, and he was told, get to the heart of the matter, find out what Carlos Ghosn did wrong and bring it to our shareholders.
It's really complicated because you had various things coming out of the weeds. 2018, the investigation has started, and we become aware of matters in terms of conflicts, actions by certain individuals that cause some concern because things might not quite be what they seem.
So in our story, we really took a close look at Harinada and his role in Carlos Ghosn's downfall.
Harinada is one of the most fascinating figures inside Nissan. He's also a lawyer. He's originally Malaysian. Hello, Mr. Hadi. And he had a meteoric rise through the company and became very, very close to Carlos Ghosn and other top figures. He had a front row seat at all the major strategic deliberations at the company. And when he discovered that Carlos Ghosn, as his final legacy play, was going to tighten the relationship between Renault and Nissan, he made a decision to go against Carlos Ghosn. And he became one of the key figures that decided that Carlos Ghosn had to go.
Harinada was somebody who actually recruited me into the company, so I have a long-standing relationship with him, or did have a long-standing relationship with him. For many, many years, he was a mentor. I had doubts about the credibility of the process right at the start. Harinada had a plea deal with the Tokyo prosecutors. Now, that suggests he was intrinsically involved in some of the wrongdoing, or the allegations of wrongdoing, and it just didn't smell right, just doesn't sit right.
So there was a basic conflict of interest. In other words, Harinada had to deliver results to Japanese prosecutors to avoid his own criminal liability, and he's accusing and leading the investigation of Carlos Ghosn.
Some of the people who had been involved in the original alleged crimes were also looking into the affairs themselves. Ravinder Pasi began pointing out some of these conflict of interest issues. And the reason for that is essentially his concern was for the company. If the company's own investigation into itself was compromised, that could lead to a very weak position in various lawsuits that it was dealing with across the world.
I had discussions with Harry, discussions with the statutory auditors about these conflicts, discussions with HR about some of these conflicts, because at that point, we reported into him. You know, at the time, everything was quite, as you can imagine, it was, we've got to do this, we've got to do that, we've got to move fast. But when you step back and look at some of these things, you just think, my God, what was going on here? Because me, members of my team, were being placed in immediate danger. Your chairman's been arrested, a representative director's been arrested. They both happen to be foreigners. And then now what we need to do, we're being instructed to do, is certain compliance professionals need to go into properties in Brazil, for example, and retrieve evidence. They've got to do it very carefully, because if they don't do it carefully, they're going to get convicted of criminal activities. And likewise, when a team of lawyers were commissioned to go to Lebanon, I mean, one of my immediate concerns was, why are lawyers from Nissan being sent to go to Lebanon to retrieve evidence? These are just lawyers, they're corporate lawyers from Nissan. You had revelations that a number of executives had benefited from share appreciation rights and they shouldn't have. I mean, you know, substantive amounts of money being taken by these guys when they weren't entitled to take them. And you do think, yes, how is this going to look later on? It's going to look quite concerning. So that triggered for me the sort of assessment that, well, I'm going to have to do something, because up until this point, I haven't put down on paper these conflicts and these issues.
So Rav Pasi makes a fateful move. He writes this letter to the board listing every suspicion he has in great detail, backed up by evidence, backed up by memos, of why this internal investigation had serious problems. He sends the letter to the board, and it's crickets. He doesn't hear much of anything.
Nothing happened thereafter. Nothing at all. Just like it just gone into a black box.
And he began to suspect that there was a desire, even at the highest level within Nissan, to kind of sweep these conflicts of interest under the rug.
Unfortunately for me, I think, you know, again, with hindsight, people must have thought that this is the nail that's sticking out, and we can't have this. Within 3 days of me submitting that to the board of directors, that letter to the independent board of directors, I was removed from the Goan Executive Conduct Matters. I was then told that I could not attend board meetings anymore. And up until that point, I had attended every single board meeting. I was then also told that after 8 years of being in Japan, I'd be going back to the UK. It eventually transpired that I'd be the VP of Projects and Transformation, managing a team of 3. So you can imagine what this feels like at this stage. Almost an arbitrary removal from Japan, where I've lived for 8 years, had 3 children there, my family has grown up, and we've been settled there, having a few months earlier been promoted to vice president at a global level, to being almost demoted.
So Pasi was essentially being reassigned to get him as far away from the internal investigation as possible, and also to a certain extent in retaliation to some of the issues that he brought up regarding the internal investigation and Harinada.
What happened to Rav Pasi can be seen as a series of corporate humiliations. I mean, first of all, his immediate responsibilities were taken away from him. Eventually, he lost, you know, the coveted general counsel title. But it didn't stop there. Toward the end of his stay in Japan, Rav and his wife were convinced that they were being followed.
During that period, I'd noticed that whilst driving my car, I'd have other cars following me. First time I noticed this was around mid-March, and I was driving, I can't remember where I was going, but this grey van, small van, just literally started following me. And I noticed that there was somebody in the car taking pictures. And lo and behold, we were absolutely being followed either by people on foot or other individuals, 2 or 3, normally 2 burly men in a car, different cars at different times, following us around. They were following the family as well. And, you know, given I'd seen the Nissan security department behave in a very, very egregious manner with others in terms of following and surveilling, I was very concerned as to what they were doing and who they were giving this information to. Because if they're giving this information to the authorities, you do think, why? What's going on here? I mean, this is just not normal behavior.
And this all culminated in a rather dramatic event in the middle of 2020.
Who are you people?
Where Nissan had hired a legal team and had obtained an unusual court order from the district court in Yokohama
to basically do a search of his home and seizure of his corporate laptop and phone and other documents.
If you don't let us in now, we have to break this key.
So it's a pretty extreme way to treat someone who'd spent 16 years at the company.
These people have all come in. We don't really know who they are, apart from the fact that I've been shown a badge that says the Yokohama court. And they're here to recover a laptop and a mobile phone. It was even more weird because I'd highlighted to the directors that certain Nissan executives were trying to recover this laptop and this phone whilst I was still in Japan. And I was very concerned because it had evidence on there that related to misconduct matters and other forms of inappropriate conduct. It was just another form of intimidation, another form of harassment, forcing me almost to leave the company and the country. Because once they'd retained and obtained these items, we were still followed, which, again, I just couldn't understand. What is the point of doing that? This isn't a car company. This is not the KGB.
I think it's fair to say that Rav Pasi didn't have full battlefield awareness of all the intrigue going on at Nissan. I mean, Harinata is interesting because he's both charismatic and charming, and one of the most brutal corporate infighters one could ever run across.
This is a confidential company email, right? You should not have this.
If he had fallen into line, he would probably still have his job at Nissan, be paid very well, and continued his work.
A career that he spent 16 years building at Nissan is irretrievably broken. It's been smashed to smithereens. He and his family paid a huge price, certainly. But in terms of being able to sleep at night, I think, he's come out ahead.
I highlighted issues to the highest levels of the company so that they could be dealt with appropriately by those in charge. There was no response to those, and there was retaliation against me. What's really profound, like absolutely profound, is that none of your colleagues, I mean people who you have known for years, forget it.
Yeah.
You're on your own.
Yeah.
And you got to be ready for that. You've got to be ready for that. If you take it on anyway.
This is the awful truth. There's always someone in the family that's pushing it.
This lady does not deserve to be taken advantage of, especially at your age with your own grandchild.
Yeah.
My grandma is having to sue them. I'm testifying against them. Nobody's talking. They're one floor below right now. I get afraid to go on the elevator. It's sad that it had to devolve to this.
It's like a soap opera.
It's a very sad thing.
It's a family feud.
A family feud.
Here's a family that, on paper, you would think has the wealth that so many people seek, yet at the end of the day, it seemed to sort of rip everybody apart. My name's Tom Schoenberg. I'm a senior reporter here at Bloomberg News, cover financial enforcement. I was approached by someone close to the Schottenstein family and asked whether or not I would be interested in writing about Beverly Schottenstein and this case that she had against J.P. Morgan. And it was immediately clear that there was a great story here to be told. So I started just, assembling all sorts of documents that the family made available to me. That included a diary that Beverly had begun writing when she started having suspicions about what was actually going on with her money. Beverly obtained her wealth from the Schottenstein kind of retail empire that has at times included Big Lots, Value City, American Eagle Outfitters, DSW Shoes. Beverly's husband died, and at which point they sold off their portion of the company, bringing them an enormous amount of wealth in around 1990. Estimates of her wealth were around $90 million. She, for many years, had that pool of money being managed by outside advisors. Her grandsons in the late 2000s had both graduated and were becoming financial advisors. She gave them a little bit to work with, and over time, her grandson, Evan, became the trustee of her entire estate. Managing sort of family money is not a conflict. In fact, some ways in wealth management, it's kind of how you get your start. It's kind of the seed that you need to sort of get going in the business. But Beverly started having suspicions that something was wrong probably in around 2016.
Well, there were suspicious things, but taken separately without everyone talking about their own experiences, it was hard to really put it together.
She had written a check to her caretaker, Dawn, that bounced. So she went down to her local Chase branch to sort of find out what was going on. She wasn't getting paper statements in the mail, so she asked them to print out a number of her statements having to do with her checking account and her credit card account.
So we went to the bank and asked for the statements. And she got a whole year and going through all of them, page by page by page.
And it was there she saw all sorts of charges that she said she didn't authorize or didn't know about.
I was becoming very, very suspicious. I was starting to look in the money part, and that's what bothered me more when I saw that money was going. And I was not a big spender.
Around the same time, Dawn, she starts noticing Beverly's son, who lived in the condominium below her, came up with Evan with a shredder and started grabbing papers in her office area, including some with J.P. Morgan letterhead, and just started sitting at the kitchen table just shredding documents over and over.
Yeah, they came in one morning.
They used to do it in the back.
Through the back door, and they brought the shredder inside. And then they went in the drawers in the office and took out all the papers, and they started doing it. I was very suspicious because I know you don't go around and destroying papers.
Beverly said that they had done this many times before.
That's when she said to me, Dawn, I'm going to write my feelings in this black book.
Diary.
And it's a diary, and she started writing. Each day she would write a little at a time.
Around the holidays of 2018, a package had arrived, a FedEx package, and in it were materials about a venture capital fund based out of the Cayman Islands. Dawn and some other family members take a look at this, and they see that Beverly is signed up for this fund to the tune of $5 million over the course of several years.
And that was really the beginning of it. That was sort of the tip of the iceberg when it became obvious that something was going on, that my grandmother really wasn't aware of this fund.
You know, Beverly started to panic. She got really upset and called, J.P. Morgan's headquarters in New York and asked for Jamie Dimon. She said she was told someone would call her back, but she says that never happened. She wrote a letter to Evan and Avi, and in there she laid out a number of things that were concerning her: unauthorized trading, the checking account. She had about $1 million worth of jewelry in a safe deposit box, and that her son Bobby had the key to that box, and that jewelry had gone missing. All this was kind of packaged in this, 5-page handwritten amendment to a will and trust.
There's such an evolving narrative about why the jewelry was taken. The only truth we really know is that the jewelry is gone. But why it happened, there have been a lot of different stories.
You just don't take your mother's wonderful things and hand it out.
And they emailed that note to J.P. Morgan to seize all activity on her account.
And it ended up setting off a firestorm after that. As soon as they got this email that there was a cease and desist and that she wanted to send her money and change brokerage firms, they were actually vacationing one floor below downstairs. They're there right now.
The next day, Beverly's in her place. The granddaughter's still in her place visiting. Dawn is there, and up comes Bobby kind of barging through the door. And he's screaming about what was sent to the J.P. Morgan. They're now investigating them. And he's furious, takes his mother and sort of puts her into a chair, gets pen and paper, and she says physically forced her to write a retraction letter.
They were pushing me around.
It was a scary time. I was really afraid, too.
I had to take her to the doctor, and she did an x-ray because she was in so much pain.
The locks had to be changed. The phone number had to be changed. I really thought we were going to have to hire guards to be outside just for protection.
Oh, it was terrible.
Horrible scene.
Beverly brought her case before the Financial Industry Regulatory Authorities, usually known as FINRA. It took several months of hearings. She sees all sorts of transactions that's going on, hundreds of them that she claims that she never knew about, never authorized, but yet were logged in J.P. Morgan's files as having been direct requests from her. That included the sale of a large amount of Apple stock worth several $1 million, as well as all her stock in Big Lots. Over the course of their time with J.P. Morgan, Evan and Avi were making all sorts of trading on her account that was generating millions of dollars in commissions for themselves and the bank, yet she was not sort of getting any of the type of gains that you would expect sort of an $80 million account in a bullish market to be able to get. They issued a ruling entirely in her favor, finding that her grandsons, as well as J.P. Morgan, they were liable for violating their fiduciary duty, misrepresenting themselves, and they also found that the bank and her grandson, Evan, were liable for elder abuse. Evan and Avi, they were fired from J.P. Morgan. They issued an award of about $19 million. I reached out for comment, and J.P. Morgan emphasized that Evan and Avi were no longer with the firm and that their actions do not represent the sort of values of the bank. I reached out to Evan and Avi, heard back from their lawyer saying that, they disagree with the law and the facts that FINRA kind of used to decide the case against them and are seeing if they can have it withdrawn. Her son, Bobby, wrote her a letter, said his sons weren't criminals, and he also admits to taking her jewelry. And he says he needed it to pay off some bad business debts he had.
They never once came up to say, I'm sorry.
If there had been an apology and some acceptance, and asking for forgiveness from my grandmother, I don't think we'd be in the position that we are now.
Since the piece came out, we've received dozens of messages from people, many of whom are telling their own sort of personal tales of, kind of financial advisors gone bad, or family members who got control of an estate and abused, those within. Seems that it's really resonated with a lot of people. I keep, hearing a lot of feedback about Beverly and how, a lot of people feel she did the right thing.
You're never too old to stand up for yourself and try to right an injustice. She was adamant that she wanted to stand up for herself, but at the end of the day, they did wrong.
It's a painful life lesson. Beverly taught them that you don't mess with grandma.
On April 20th, oil markets did something they never had before, and they crashed, went into negative territory and closed the day at minus $40. Meanwhile, in a place called Thaden Boyce in Essex, a group of 9 traders, led by a guy called Cuddles, made $660 million over the course of a couple of hours.
The price of oil has collapsed to a record low.
We've never really seen anything like it. WTI this morning down more than 35%.
People maybe wouldn't have been so surprised if the oil price had fallen to zero, but the oil price went to minus 38. It went far lower than anyone had expected. And so lots of people in the market were saying, well, hang on, something else is going on here.
A couple of months later, I started to get wind through a kind of network of sources that a tiny firm in the outskirts of London had made a huge amount of money that day and potentially had some part to play in what happened.
The information we got was that 9 traders at Vega Capital London had made in the region of $660 million in one day. As a group, I think they made as much money in one day as Apple makes from its international sales in one day. I mean, it's an insane sum of money.
Did they pull off a fantastic trade? Did they predict the way the market was moving and get it absolutely right? Or was there something else going on, and had they actually done something that breached market rules in a bid to sort of push the market? And that investigation is ongoing. So Paul Commins is a trader who cut his teeth in the pits in the 80s and 90s. When everyone had a nickname, his was Cuddles. If you can imagine, that was a very sort of cutthroat type of world where people are doing, hundreds of thousands and millions of dollars trades by shouting at each other, giving hand signals, and then sort of scrawling on scraps of paper.
The culture of the trading pits in London was very influenced by the working class guys who became traders there. They weren't like the city bankers that had gone before them. They weren't usually Oxford or Cambridge. They didn't wear Savile Row suits. They were ordinary working guys who happened to have a talent for trading. And a lot of them came from Essex.
I think it was 400 traders in the pits, and Cuddles in his oil and gas pit was described to us as amongst the top 3. In amongst that, was very successful and made very large amounts of money as a young man. But inevitably, mechanization and the arrival of electronic markets was the kind of death knell for the pits. And in 2005, the IPE closed down.
And when the pits shut down, a lot of the traders who worked there lost their jobs or quit or went to work for financial institutions. But Paul Commins decided to start his own trading collective out in Essex.
Some of them are ex-pit guys, cut from the same cloth as him. Lots of them are actually sort of in their 20s, and they're his, drinking buddy's son, or they're his own kids' friends from football. They're young lads, hungry and ambitious, and he brings them into the fold. And fairly shortly, he's got, maybe a dozen or so traders that they're independent, let's be clear, but they're all part of this collective.
Yeah, I'll let Liam deal with Essex.
I am from Essex, so I feel like I'm free to, to get into this.
Sweet, as they say.
If you were to ask someone in Britain how they would imagine a kind of Essex person, they would see someone who's maybe slightly flamboyant, with a sort of Cockney accent, a sort of Guy Ritchie-style accent. Not afraid to splash the cash, but it's probably pretty bright and has done well for themselves.
Don't even make sense, does it?
But, these guys, they drove around very nice Rolls Royces and Bentleys. They went to places like Marbella on holiday.
Thaden Boyce is a very wealthy place. You have to have considerable income to be able to afford to live in that village. It's a really nice place to live, and it's 20 minutes tube ride away from the city.
Earlier in the summer, we have this lead, which is that there's this tiny firm called Vega Capital London, and they were the biggest winners from the biggest oil crash in history. Anyone that covers markets is going to be surprised about that. You're thinking your BPs of the world or your Glencores, but it's this tiny firm.
And one of the big challenges that we had was actually finding out who worked with Vega Capital. It wasn't immediately obvious, and at first we had absolutely no idea. If you go to the Vega Capital website, it says it's under construction. If you do basic online searching, it's very difficult to find anyone who's publicly connected to the company.
So inevitably, we're incredibly curious at this point. Like, who the hell are these people?
The more reporting we did, the more it became clear that this group were connected socially as well as professionally. They went to weddings together, they played golf together, they would go on holiday together. We found out that a number of them were members of the West Ham Supporters Club in London. A few of them started companies together, so you could see all the connections between them and start to see a distinct group emerging.
And it really just was this kind of shock that, this wasn't just like a hedge fund or a firm you'd never heard of. This was actually a group of buddies who all had the same experience on this day and had all made a huge amount of money. So if you're an oil trader, there's a number of different ways you can trade, and probably the most popular is WTI futures contracts.
And it's basically a contract that says, I'm going to buy 1,000 barrels of oil from you at this point in the future, or I'm going to sell 1,000 barrels of oil to you at this point in the future.
It's actually just a financial contract to gamble on to predict whether oil is going to go up or down.
On the 20th of April in Essex, there had been signals for a while that this was going to be an exceptional day in oil markets. And we know that some of them arose early and started their trading in the early hours of the morning while it was still dark outside.
Essentially what they were doing is buying contracts that gave them an obligation to buy oil at whatever the price ended up at 2:30 p.m. So they're basically placing a bet that oil is going to fall throughout the day.
But they're simultaneously selling lots of oil as well. And whether they make a profit and how much profit they make is the difference between what they buy the oil for and what they sell the oil for. Now, of course, we now know throughout April 20th, the price dropped and dropped.
So this is going very well for them. They are committed to selling oil at these prices, and the prices are continuing to fall, which means they're going to be able to offset it and buy oil at cheaper at the end of the day. Now, once it gets to kind of 1:30, 2 p.m., that's when things start to get really interesting. Suddenly there's a kind of influx of buyers and sellers, as desperation increases in the market and trading volumes go up. Now at 2:08 p.m. exactly, something bizarre and unprecedented happened, which is that oil passes into negative territory.
And it fell to a record level of minus $38.
We've never seen anything like it, period, in terms of the contraction of the global economy.
That huge gulf between what they were buying the oil for and what they were selling it for enabled them to make more money than they ever thought possible.
So their profit was the difference between minus 37, and all of these positive numbers on every contract they sold.
The price of crude briefly hit minus $37 a barrel. For one group of traders operating from a small office, it was a very, very profitable day.
It's important to remember this had never happened before in the history of oil trading. No one could have predicted it.
I can't think of another example of where you enter a trade and you get paid on both sides. You get paid both to sell and to buy. It's unthinkable.
One thing we know about the Cuddles Trading Arcade is that they were very comfortable taking large risks. And, you have to be clear, this was a large risk.
Yeah, we spoke to oil traders, both people that know these guys and people that don't, and they all say that this is, incredibly risky.
And that's actually what stops a lot of oil traders doing trading like this. They simply aren't willing to stomach the risk. But Cuddles and his friends were.
So when the kind of final calculations came down, the group of the 9 most profitable traders made $660 million or thereabouts between them. I mean, if you can imagine, I think 3 or 4 of them made in excess of 100 million each.
One of the astonishing things about this trade is that 2 of the individuals who made more than $100 million in a single day were in their 20s. One of them was 22 years old. Only a few years earlier, he'd been posting on his social media about doing teenage stuff with his mates in town and going to see girls and rap music. And here he is a few years later making $100 million in a single day's trading. When me and Liam discovered that, we couldn't believe it. We couldn't believe what we were seeing. Oil trading is a zero-sum game. Anytime you're making money as an oil trader, someone else is losing it.
Amongst the biggest losers were the investors in this Chinese fund, Crude Oil Treasure Fund. There were thousands of them, and they lost everything.
Lots of people had put their savings into oil funds. They lost money that day. Big banks and brokers who sort of stand in the middle of trading parties, they lost money that day.
And another interesting thing is that oil-producing countries like Kuwait or Canada, they sell oil as an average of the WTI closing price over the preceding month. So the fact that one of those numbers in that average was minus 37 meant, if you can imagine, countries like Saudi Arabia and Kuwait potentially lost a couple of dollars on every single barrel of oil they sold that month.
Vega Capital's traders made such an extraordinary sum of money that it was inevitable there would be some scrutiny of what they did. But it wasn't just the sums of money they made. In the vital half an hour before the settlement price was set, they were by far the biggest sellers of oil futures in the market, which is an incredible thing to think about when you consider that the other participants in that oil market are going to be the world's biggest banks, oil majors, BP and Shell, and here you have a group of 9 guys in Essex who are having this significant influence over a global market for oil.
I mean, I think you have to assume that if these guys had made $7 million or $10 million, they probably would be celebrating in Essex right now. But the fact that they made closer to $700 million has meant that they are facing understandable scrutiny.
We wrote individually to all the Vega traders who did exceptionally well that day, and we got a letter in response from a law firm representing the group. The law firm was at pains to point out, number one, that they haven't been accused of any wrongdoing, that they all traded independently and separately, and they'd basically all made up their own minds that this was what was going to happen in oil markets based on publicly available knowledge, and decided to execute this trade.
What I love about these stories is there's a real variance of opinion, and some people will look at what happened and think that must be dodgy. They all traded at the end of the day. They all made a huge amount of money while all these people lost. That's shocking. But lots of people say these guys are at acute disadvantage. They're in a market that's inhabited by, huge technology-driven funds and firms and oil giants that have got all the advantages in the world, and when you get a bunch of Essex geezers who essentially beat the market and find a way to make a huge amount of money, they should get a pat on the back, really, because that's the dream. Since this happened, a lot of the guys have stopped trading the monthly settlements that they'd done so well at in the past. Several of them have set up new companies. They've essentially gone very quiet. Any kind of social media presence they had is kind of closed down. By all accounts, they're, waiting this out.
It's certainly too early to try and predict how the regulatory investigations are going to pan out. We just don't know. There's a number of potential outcomes for these guys. Potential punishments if there are any findings of manipulation against Vega or anyone affiliated with it might be you could be fined, you could be banned from trading, and in the most extreme cases there have even been criminal prosecutions in the past of people who have been found to have been manipulating the settlement and misconduct related to trade at settlement. There are other outcomes too. One obvious one is going to be that they're able to walk away from this life-changing trade with all the money that they made and celebrated as heroes in the trading community. That they'll go down as legends.
It's very important, given the nature of the climate crisis right now, for the general public to have an understanding of what progress is or is not actually happening. And I think many readers right now, they'll see these hundreds and hundreds of companies making these big, bold climate claims. And they would be forgiven to think that we're well on our way to meeting the emission reduction trajectory we need to be on. And the reality of the matter is we're just not on that trajectory. And a key reason for this sort of disconnect is the use of offsets that aren't doing what they claim to be doing.
We have a massive potential for sort of willful blindness. We can convince ourselves of things regardless of what the facts are. And so that's what tends to happen in these cases. It's not that anybody is setting out to commit climate fraud. They sort of walk themselves into a situation and they convince themselves of one thing, and that allows them to convince themselves of another thing. But at the end of the day, they're doing something that makes no sense at all.
My name is Ben Elgin. I wrote the story about how the billion-dollar market for carbon offsets is setting back the fight against climate change. So one of the challenges in reporting on carbon offsets and trying to figure out what's going on is really finding good experts who have been steeped in this marketplace and are willing to candidly talk about it. One of the best people for this is a fellow named Mark Trexler, and I've been talking to him for more than a decade.
My name is Mark Trexler. I've worked in climate change for the last 30 years. I was actually hired by the World Resources Institute in Washington to work on the first carbon offset project in 1988. In terms of defining a carbon offset, one of the beauties, so to speak, of greenhouse gases, sort of the silver lining of greenhouse gases, when you put up a molecule of CO2 into the atmosphere, it can be anywhere in the planet in 7 days. And therefore, if there's an option to reduce emissions on the other side of the planet, and you can do that very cheaply as compared to doing it in your factory, for example, then why not pay that person, that factory on the other side of the planet to reduce their emissions? Then you are, in a sense, offsetting your emissions, and the atmosphere doesn't really see your emissions anymore.
So carbon offsets have been around for quite some time, and they were actually key with these international climate agreements, such as the Kyoto Protocol, which mandated the wealthiest countries reduce their greenhouse gas emissions.
The treaty was signed on the 11th of December, 1997.
Decided. The business community in general saw carbon offsets as a huge opportunity to comply with whatever policies and measures might be coming down the pike on climate change much more cost effectively.
We've seen a huge surge in companies making big proclamations about how they're going carbon neutral or zeroing out all of their carbon emissions.
We're going to reduce our carbon footprint to net zero.
Unilever is committing to net zero emissions.
We can achieve a net zero emissions world.
We began looking at these corporate claims of dramatically reduced emissions, and we noticed so many of these companies were using carbon offsets to achieve these aims. And as we began to look at the carbon offset projects themselves, what we found is that the environmental benefits claimed by these companies are not actually what they seem to be. And as we sort of saw and spotted a number of these very aggressive carbon offset projects, which appeared to be generating inflated credits or bogus credits, we saw a number of them were associated with the Nature Conservancy. This surprised us. The Nature Conservancy is the world's biggest environmental group. They have about $1 billion a year in revenues, and they've been around for 7 decades. They've preserved about 125 million acres of land, and they've done so many good works over the years, and they've been very strong in terms of working with corporate partners. The Nature Conservancy has taken a different approach, a very pragmatic and pro-business approach. They will not go out and criticize a big polluter, but they're very happy to work with them. Some might say that, well, that's selling out, but others would say, and those at the Nature Conservancy would say, these companies have deep pockets. They can help fund important preservation work, and we have absolutely no problem working with them on this stuff. So companies are very warm, and they've partnered with the Nature Conservancy for many years. And yeah, it definitely lends a sheen of credibility to these projects.
Here's 20 new reasons to visit Disney World this year. 1, 2, 3, 4.
If you look at, for instance, Disney, that's a sprawling company with theme parks and cruise lines that burn up diesel fuel. They have office buildings and television studios that consume electricity. So these companies are trying to make major reductions in their carbon footprints, but it's very difficult to change these fundamental ways their businesses operate. So Disney has been a big buyer of carbon offsets that are orchestrated by the Nature Conservancy. One of the projects that they buy from is called Pennsylvania Ridges. And that's a plot of land. Most of the land is actually about a 3-hour drive outside of Philadelphia. Interestingly, this land, 3,000 of these acres, was actually acquired by the Nature Conservancy in the late 1990s. This land was imminently threatened. There was a pending logging contract on this land. So they do what they've done so well for all of these years, which is they go out, they raise money from local philanthropists, and they go buy this land to protect it from developers and loggers. And at the time, according to an archived version of the Nature Conservancy's website, when they were proudly announcing this deal, they said, these threats have been abated because of this acquisition by the Nature Conservancy. So it's really interesting now, fast forward 2 decades to earlier this year when they put forward this carbon project. And if you look through it, this land is a key part of that carbon project. And what they're now saying is this land is now, once again, imminently threatened. 72% of the trees are going to be cut within 5 years. Now, this is just astounding because this land is owned by the Nature Conservancy. They do not clear-cut land that they've bought through philanthropic donations. So this scenario that they've put forward to get carbon revenues is not really plausible. And what that means is when you have Disney coming in and buying these credits, when it eventually lowers its carbon footprint because of these credits, well, that won't be a credible or truthful claim by Disney. So this is an organization that truly understands the threat of the issue of climate change and is wanting to do its part to address this. However, in this situation, it just appears their drive, which they've had for decades, to increase the amount of revenues that it can use for land preservation work, Nature Conservancy and many others see that the carbon credits as a pot of money that they can tap into to further their own benevolent aims. But unfortunately, what this has resulted in is claims of climate progress that just aren't really happening. So the Nature Conservancy defends vigorously these deals, and they and others will say, look, our projects are just following the rules that these registries set up. So some would also put some of the blame on the registries themselves because they're setting up the rules which allow these vapid projects to get up and sold. So we've reached out to all of the companies we mentioned in this story, including Disney. They didn't want to be interviewed for this story, but they all told us that, look, we have to rely on the experts out there, and those experts, they say, are these carbon registries that have been set up. Most of these Nature Conservancy deals are set up and sold on this exchange. It's called the American Carbon Registry. Now, it's the oldest of these registries that allow voluntary carbon credits to be sold. They've been around since 1996. What these offset registries do is they set up rules, and any carbon offset project has to follow those rules. But there's this tension that's always there. If the rules are too strict, then it's going to be very hard for carbon offset projects to get up and running. So there's this balance going on where the registries want rules that attract projects, but they don't want it to be so strict where it will disincentivize projects from getting listed.
One of the challenges with designing carbon offset systems is that there are normally two people at the table. You have buyers and you have sellers. And to some extent, you have policymakers, but you know, the buyers and the sellers are really the ones with the expertise, with the incentive to really participate hard, make a lot of things happen. And the challenge there is that both of them sort of want the same thing, or they're both happy with the same thing. They're happy with low-cost offsets and a lot of them, because that works for their business model. You end up, though, with nobody really representing the atmosphere, so to speak. Nobody's really representing the climate in those discussions. And so the policies end up biasing the whole system. And you end up in sort of a race to the bottom. And that's what we've seen happen. You know, when it comes specifically to the topic of carbon offsets, you know, I am a fan of carbon offsets in the sense that they can help mitigate climate change. They absolutely can. But, you know, if we're not going to do it correctly in a way that actually does help mitigate climate change, then it's nothing but a distraction. And, you know, after 30 years, you have to start wondering, is it really just a distraction? And that's really unfortunate, but that's where we are. Ultimately, what needs to happen is systemic change. You know, we're sort of nibbling around the edges with some of these different things. We need to change how we produce energy. We need to change how we transport ourselves. We need to change what and how we eat. You know, we need systemic change associated with transitioning to a low carbon economy. A lot of what we're doing today is not promoting systemic change. It's sort of trying to stick your thumb in the dike to preserve the current system. And at the end of the day, that can't really work.
the Hyperloop. There's a good chance you've heard the name by now.
This is the Hyperloop system. It can take people hundreds of miles in minutes.
The Hyperloop, a series of tubes that would transport people in pods at ultra-high speeds over long distances.
This is a remarkable new form of transportation that can whisk people from city to city in a flash.
29 minutes from New York to D.C., 30 minutes from L.A. to San Francisco.
For years, we've been seeing these futuristic, utopian renderings of some cross between a spaceship and a monorail. But lately, the Hyperloop is becoming much more real.
Yes. It was surreal to be even sitting inside a Hyperloop, and just even more incredible to actually be like riding down a track in something that was nothing more than a crazy idea 6 years before.
Companies all around the world have been developing and testing the technology needed to propel passengers at speeds of over 1,000 kilometers per hour. But for many, speed is only the first step to unlocking the full transformational effects of a new mode of transportation.
Fast is what we just sort of take for granted in the Hyperloop world. It's the network effects that really deliver the benefit. And that opens up a completely different scale of economic opportunity.
We've got planes, trains, automobiles, and boats for getting around Earth. But what if there was a fifth mode? And I have a name for it, which is called the Hyperloop.
The Hyperloop?
Hyperloop, yeah.
In 2013, while riding high on the growing success of Tesla and SpaceX, entrepreneur Elon Musk released a white paper outlining the basic framework of the technology he called Hyperloop. The basic idea goes a little something like this. A tube reduces the air pressure to a near vacuum-like environment. A Hyperloop pod is then suspended in the tube, usually by magnetic levitation. The whole pod can then be propelled forward. Because there's no traditional friction sources like air resistance or rolling friction that would push back against the pod, the Hyperloop is able to move at incredibly high speeds and do so fairly efficiently. Despite its futuristic name, however, the general concept behind Hyperloop is actually pretty old. In fact, New York City's first attempt at an underground public transit system in the 1870s was based on a similar principle. The pneumatic transit system was short-lived, however, only stretching one block and topping out at a rather leisurely 10 miles per hour. While Elon would make some 21st century improvements to this concept and bestow a very 21st century name, he wouldn't end up pursuing the technology itself, instead electing to focus his efforts on something a little bit deeper, literally digging the requisite tunnels via his boring company. It would take another billionaire industrialist who dabbles in spaceflight. No, wait, not that one. Yeah, that's the one. After Richard Branson would make a large investment in the company Hyperloop One, it would be renamed to Virgin Hyperloop.
What we've always been trying to do as a company is show that this technology could work, that it could be made safe, and that ultimately it's something that's happening in the next couple of years, not the next 20 years.
Josh Geigel is the co-founder and CEO of Virgin Hyperloop. In a familiar tech startup story, he's seen the project go from a garage to a large-scale testing facility outside of Las Vegas.
So we started building the first kind of Hyperloop system in 2016. We've done a lot of work, about 500 tests that we've done on that over the last 5 years. And what we realized that we need to do is take that technology, show that it can be commercial, so drive the cost down, improve the efficiency, improve the performance. But the key thing is actually making it approachable and safe for individuals.
In order to do that, Josh, along with Virgin's head of passenger experience, Sarah Lucian, bravely volunteered to take the inaugural ride.
What her and I were realizing is we're the first two people sitting in a Hyperloop. The only type of people that have gone through this environment are in spacesuits, and there we are in just normal clothes because of the system, the safety of what we've designed.
3, 2, 1, launch.
And then once we started going, you felt a bit of acceleration. We accelerated a little bit harder than we would in commercial. It'd be like a sports car. Yes. We got to about 108 miles an hour on that test. And it's a short run. It's about 500 yards or so. And came to a stop.
The test, lasting only about 20 seconds and covering only a quarter of a mile at just over 100 miles per hour, is a long way away from a true functioning Hyperloop. But as for optics, it's a crucial step for the future of funding.
The number one question we got from investors or from project proponents or just people in general was like, is a Hyperloop safe? And what better way to show something is safe than by actually getting people on it?
But convincing investors and governments that would likely be fronting some of the construction costs for an unproven technology is no easy task. First and foremost is the question of safety.
Most people don't know how an airplane works, but yet they get on an airplane. They get on an airplane because, it's faster than driving, and most importantly, they've probably gotten off of one before, they've seen someone get off of one before. And so what we set out to do was actually show that Hyperloop could be safe with two normal people, not astronauts, not adrenaline junkies or test pilots or anything like that. Two normal people getting on a Hyperloop, and then most importantly, those two people getting off.
But beyond safety concerns, constructing Hyperloops will undoubtedly require a significant capital investment to the estimated tune of around $60 million per kilometer of track. So a track from San Francisco to Los Angeles, for example, is likely to come with a price tag over $10 billion. And before large governments are willing to come in and front those costs, investors who are funding Hyperloop development must accept it as a long-term mixture of technology and infrastructure investing.
Investors that are used to short returns because you're developing apps or something to that effect, those aren't the investors that really get excited about Hyperloop. What you start to see is the people that are looking at platform technologies, right? So this idea that because the smartphone existed, Uber could exist, right? So who are like the Vanderbilts of this century? And that's the part where you're going to get a lot more no's than yeses. But those people that have the ability, the fortitude to stick it out, to see the game-changing platform here, those are the people that we're looking for. And since we've done that passenger test, there has been a lot of interest that's really, this is a lot sooner than I thought.
Envisioning the ripple effects of what Hyperloop could achieve, though, is fairly challenging at this stage of development. It's fast, yes, but for point-to-point travel, traditional maglev trains can move pretty fast as well. And outside of China, South Korea, and Japan, even those haven't seen much adoption elsewhere due to the high costs and questionable profitability. The Shanghai line in China, for example, loses around $100 million every year. Hyperloop companies, however, believe they can offer something different than traditional railway lines.
My name's Alan James, and as far as I know, I'm the only guy on the planet who's written a government-level business case for 300 kmh conventional high-speed rail, 500 kmh maglev, and 1,000 kmh Hyperloop. It's fundamentally about moving people from where they are to where they want to go, when they want to make those journeys, and doing it in much smaller numbers. So pod designs for Hyperloop range from 12 to 28 seats, typically. Why are they small? It's because small enables the network to operate flexibly. And a great example of that is the east-west strategic route across the north of England, from Liverpool to Manchester to Leeds. So to get from Liverpool via Manchester to Leeds by train is just short of 2 hours today. It'll probably take you 2 hours driving as well in average traffic conditions. Net result is those three city regions remain three separate entities: Liverpool, Manchester, Leeds. There's very little commuting traffic between those urban areas. Hyperloop absolutely changes that from the ground up. Liverpool to Manchester is a 5 or 6 minute journey. Manchester to Leeds is also a 5 or 6 minute journey. What that effectively does is create a single supercity economy.
In this vision, the Hyperloop acts a little more like a highway, where pods have fixed destinations and don't need to stop along the way. Meaning you can travel on a Hyperloop network from, say, Liverpool to Leeds, while the pod behind you travels from Liverpool to Manchester. And if that metro Hyperloop network is connected to other networks from the same location, you could travel from Liverpool to Paris or Liverpool to Amsterdam, all without making a single stop.
For passengers, for business, for leisure, that is utterly transformational. For high-value freight and logistics, it's equally transformational. But critically, if you do a Hyperloop network at scale, you begin to deliver massively significant carbon savings too.
A multi-regional Hyperloop network could become a replacement for both short-haul passenger and cargo flights and traditional ground transportation, both of which are significant carbon producers.
One Hyperloop-connected distribution hub, perhaps at an airport that is predominantly used for international air freight, replacing maybe 10, 12, 15 distributed road hubs. It takes a lot of polluting and inefficient truck haulage off the roads. That itself means roads gain extra capacity.
Hyperloops will still need to use electricity to both move pods and maintain the near-vacuum environment in the tube. Proponents of the technology believe that this can be done by using renewable sources, including a combination of solar panels and battery technology that could be used along the Hyperloop itself. But even with all multipliers of time and carbon emission savings that a Hyperloop network may provide, the investment capital required to actually build such a network becomes even more economically and politically daunting.
Committing doesn't mean spending billions on day one. Committing means, how do we phase it?
One company in the Netherlands is working to develop that technology, and perhaps more importantly, the international coalition needed to make the Hyperloop network a reality.
So we are here in Europe's first full-scale Hyperloop test facility, where we can already prove every conceptual technology of the Hyperloop.
This is Tim Houter, a co-founder and CEO of Hart Hyperloop, headquartered in the city of Delft. And while this testing tube might not seem as large as others, inside is a key technology to create the on- and off-ramp type infrastructure of a Hyperloop network. That is, a lane switch.
That's something we can already test here. You can actually see it here, that the track is diverging from one track into two. That makes it possible to eventually split up the Hyperloop track in two sections. And in that sense, you can create a complete Hyperloop network that in the end will make it possible to travel, for example, over a whole continent. And take Europe, for example, with the same ease as you can now travel with a metro in a city.
The nice thing about this magnetic levitation system that we've developed is that there's absolutely zero moving components in the track. So for example, if you have to do a lane switch, all you do is that the tube basically splits up, and statically the tracks also split up. And whenever the vehicle enters a switch, it either pulls itself to the right with its magnets, or it pulls itself to the left with its magnets.
Lane switching on traditional rail requires the physical movement of the rail. Even modern magnetic levitation tracks use lane switching techniques in order to transfer trains from one track to another.
And this is a very crucial element, because this is the thing that limits the capacity and, in the end, the usefulness of the rail network. Because the moment that a track is switching, that means that at that moment you are creating an unsafe environment for the trains behind it. So you need a lot of space between trains. In a Hyperloop, because you have no moving components in the track, all the vehicles can be much closer to each other. You can achieve a very high frequency and basically have your vehicles moving and merging in and out of the network very much like a highway.
For now, though, Hart's physical testing has been limited by the size of their tube. Because the test track is only 30 meters long, they haven't tested this lane switch at speeds greater than 20 kilometers per hour. However, the company is working to build a new test site where it plans to increase that testing speed to 300 kilometers per hour.
We're now in a phase where we have proven most of the most important technologies in the test facilities that we already have. And we have also demonstrated the viability and the feasibility of a network. If you look at all the subsystems that it consists of, most of those are proven systems, already demonstrated in lab conditions. So we don't really believe that the technology itself is going to be the biggest challenge.
Because for all Hyperloop companies out there, actually building a Hyperloop system requires more than just a good product.
We're talking about the safety aspects, we're talking about integration into the environment, we're talking about the social aspects. Do people feel comfortable traveling in such a system? So it's about all these different aspects, and the complexity is really getting all the different stakeholders that are relevant and that do need to contribute to bring this to market, to get them all following the same roadmap.
In order to help build this coalition of private and public interest in Hyperloop development, HART in 2018 partnered with other Hyperloop companies from Europe and Canada. The goal was to define, establish, and standardize the framework to regulate Hyperloop systems.
Right now we are working with all the Hyperloop developers together in setting up the first, let's say, structure for starting the standards drafting.
One of the most important goals for HART is interoperability, which is essentially making sure that different systems can communicate with each other.
Interoperability is so important because what we want to achieve is actually have this seamless travel experience. So you don't want to end up, for example, going from Madrid to Paris and then switching because you need to use a different technology to get, for example, to Amsterdam.
The idea being that as companies around Europe create the first commercial Hyperloop tracks between individual cities, one day those can all be connected to a larger network.
Everyone that believes that Hyperloop is a future transport system also realizes that there is a need to have this network because that's where Hyperloop thrives.
Hyperloop is such a huge project. It's definitely not something that you can do on your own or as a single company. So you need to do it with a lot of other companies. You need to have the governments. And I think in that sense, the biggest challenge that we've encountered is to really get all the required parties together to take the steps in development and in commercial implementation.
HART's next plan is to build the European Hyperloop Center, an open testing facility which will include a 2.6-kilometer test track. And the company hopes to test travel speeds there at up to 700 kilometers per hour. Virgin Hyperloop is also racing to construct the first commercial Hyperloop route, with projects in various states of development in India, Saudi Arabia, and the United States. Recently, the company announced plans to build a Hyperloop certification center in West Virginia, which will include a 6-mile-long test track. Proving the technology here will be crucial if Hyperloop networks can find a home among infrastructure investments that the Biden administration hopes to make.
The idea that there's multiple Hyperloop companies, I think, is a redeeming aspect in the business. People really want to see something happen, so having multiple people move forward is good for that.
I was struck when Josh and Sarah rode the pod. 2 or 3 of the major outlets used the phrase, "We now have a new mode of transport." And although all of that technology had existed before those 2 human beings rode it, it was the moment at which those 2 human beings traveled that short distance down the tube that in popular imagination, Hyperloop became a mode of transport.
The metaphor I use with my team is that, the Wright brothers were first, but none of us fly on Wright Brothers Airlines anymore. If you don't continue to innovate, you're not going to be around, and so we'll continue to be at the forefront of building Hyperloop.
Back in 2013, Elon had an idea I think the difference now in 2021 is some brilliant engineers have spent real time grinding out the details. And I thoroughly expect the next 3 to 5 years to be decisive.
This week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
Hydrogen technologies are not new. They are used in other sectors. We use them in space, on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
From Bloomberg's global headquarters in New York, I'm Kaylee Lines, and this is Bloomberg Green. It's a new year, so here at Bloomberg Green, we're highlighting new solutions in the fight against climate change. And one of those is as old as the universe itself, hydrogen. It's the simplest element around, but could well be a game changer when it comes to turning around our dependence on fossil fuels. Today, hydrogen is used in the chemicals industry to produce petroleum products. It's also starting to be used in steel production, an industry under a lot of pressure to decarbonize. But it has far more uses as well, from powering cars to heating our homes. And Bloomberg New Energy Finance sees a seismic shift in the sector in the next 10 years as green hydrogen squeezes out dirtier alternatives. So-called gray hydrogen dominates today. But as renewable electricity gets cheaper and more accessible, so will green hydrogen. In this week's edition of Bloomberg Green, we'll explore what this push into hydrogen means for tackling climate change. We'll hear from Australian billionaire Twiggy Forrest about his pivot from iron ore to hydrogen, and we'll also speak with the CEO of Italian utility company Snam about his book, The Hydrogen Revolution. But first, what are we using hydrogen for, and why does it actually matter? Christine Lee Edwards explains.
Hydrogen, the most plentiful element in the universe.
On Earth, we find it mostly bonded to oxygen in the form of water, or in other gases known as hydrocarbons. Hydrogen gas, H2, burns hot and clean, making it an attractive tool in the race to net zero. But isolating hydrogen from other elements is no easy task. Today, the cheapest way to do this is via chemical processes that break up natural gas. This releases a lot of carbon dioxide. Another method is to use electricity to split water molecules in a process called electrolysis. Although there is no carbon byproduct, a lot of electricity is needed. And if this power comes from burning coal or gas, it negates the zero emissions goals of using hydrogen to begin with. Hydrogen produced in this way, powered by fossil fuels, is called gray hydrogen. If carbon capture and storage is used together with fossil fuels, then it becomes blue hydrogen. If nuclear power is used, it's called pink. And finally, green hydrogen is when it's produced via electrolysis and powered from renewable sources. This method is considered emissions-free. It's predicted that by the early 2030s, H2 made from renewables will be cheaper than that made from fossil fuels. But that hinges on the cost of electrolysis declining, which will be achieved through larger projects and an expansion of manufacturing. To be clear, vast amounts of H2 are already used today. Global production in 2018 totaled 117 million metric tons. This hydrogen is mostly used for its chemical properties, not as a source of energy, and very little of it is clean. Some sectors like steel could start using hydrogen for these chemical properties, replacing coal. Industries like cement and glass may also use hydrogen as a source of heat. Another advantage is its energy storage potential. It can be stored over long periods of time and used when more power needs to be added to the grid. It also could hold an advantage over batteries in heavy transport and shipping. The promise of hydrogen for energy has been around since at least 1874, when Jules Verne wrote about it in his book, The Mysterious Island. But the future of hydrogen will depend on policy. Countries with net zero targets, carbon pricing, and hydrogen strategies with investment mechanisms are likely to see the highest H2 demand.
That was Bloomberg's Christine Lee Edwards explaining what hydrogen means for the energy transition. But how are businesses approaching the sector? Well, one of Australia's richest men is making a big play into hydrogen. Andrew Forrest, better known as Twiggy, made his fortune from iron ore, being the chairman, former CEO, and major shareholder in Fortescue Metals, one of the world's biggest miners. But after having made over $10 billion in profit from the metal in the last fiscal year, Twiggy wants to transform Fortescue into a clean energy company. He's been scouring the planet in search of investment opportunities in hydrogen and renewables. The firm plans to allocate up to 10% of its annual profits for green energy investments and is exploring projects across the globe, from Indonesia to Argentina. Francine Lacqua caught up with Twiggy Forrest.
There's only one type of clean hydrogen, all the rest is dirty.
Yeah.
That is green. If you just say green hydrogen is clean, the rest is dirty, then you've actually nailed it. And, you know, anyone else who produces any other rubbish, any other argument, just look them there and say, why is global warming accelerating if anything you're saying is true? And then you'll know, actually, it's greenwashing.
Yeah, but there's a lot of greenwashing because I keep on being told it's a transition. We can't just, make the transition at a click of a finger. So what are we doing wrong? What can we do better?
I don't remember the personal computer having to transition the typewriter. I really don't remember that. I don't remember the smartphone having to transition the pocket calculator and the old landline. You know, its transition line is complete rubbish. The lie got put to it 2 days ago when JCB, a really loved British company, every right for the country to be proud of JCB, and Fortescue, holding a bit of a similar reputation, fantastic track record, everyone's been super well from Fortescue, huge balance sheet, super strong. When those two companies got together and agreed a $7 to $9 billion US agreement per annum, right, then that's a real wake-up call to say, hang on, green hydrogen is obviously commercial now. You know, every other form of fossil fuel hydrogen, you know, it can compete with it on price, it can probably lose on price, but what we know, it is cooking the planet. And only green hydrogen zero methane, zero carbon in the supply chain. Don't worry about the molecules in the supply chain.
But at the moment, we're not even phasing out coal, if you look at the G20 communique. So we have a long way to go to talk about only using green hydrogen.
Yeah, so look, I have a call, which I'd like to make now, that the world should not fund any more coal-fired power stations, coal mining projects, ever. We should wind them down as quickly as possible because they are cooking the planet just like grey and blue hydrogen is cooking the planet.
Yeah.
You know, hydrogen, which is not made from renewable electricity, is releasing 10 to 16 times more carbon, let alone the methane, which is worse, than it is hydrogen. So we've just got to stop doing things which are self-harming under the guise of greenwashing.
So why are leaders so slow? Even if you look at the appetite for ESG investments, they're growing exponentially, so are emissions. So where are we allocating capital?
Okay, so take the recent G20. There's probably a reason why there wasn't strong action coming out of the G20 because people were not aware that major transactions between large companies were taking place now on green hydrogen, that actually this pollution-free all the way through the supply chain fuel is now being transacted at multi-billion-dollar scale. If they'd known that, I don't believe any sovereign leader or any energy minister or climate change minister could not take ultra seriously that green hydrogen is now here to stay. It's broken through. History has been made. It will never go back.
Okay, what is the one thing that you would tell leaders today and business leaders? How do we transition faster than what we are now because we're at real risk of missing our targets?
Oh, so that's really simple. You stop funding, you stop subsidizing, you stop using money into fossil fuels. It could be carbon sequestration, it could be fuel rebates, could be anything. Hundreds of billions of dollars getting ashed while we ash the planet on fossil fuel subsidies. Because we haven't had that renewable electricity, we haven't had that green hydrogen, we've kind of been pushed down. It's all sorts of excuses. Oh, it'll never be commercial, it'll never be supplied in the quantities we need it, you know, blah, blah, blah. Now we know, let's take action. It's practical, it's implementable, let's do it now.
Okay, if we do it now, is there going to be a shock to the energy system? Is there going to be a shock actually to economically? And is it worth, you know, not talking about transition, just going from A to B?
Yeah, it's a fantastic question. A to B is the solution. Let fossil fuels do what fossil fuels do. Just burn their coal, burn their oil, burn the gas. At least they're pumping up carbon and methane into the atmosphere, honestly. Well, not that honest because they don't measure methane, which is 90 times worse than carbon. But at least the carbon is being done honestly. Encourage the green hydrogen sector to come in really fast. Okay, it's there. There's renewable power all over the world. We now know how to make electrolyzers much cheaper, like 25% of the original cost. We know how to do that now. We don't have an excuse to get into it.
Does it need to be cheaper than oil and fossil fuel for it to be viable worldwide?
Well, right now it is. Okay, so let's just swallow that bit of financial data. Right now it is cheaper, and it's getting more cheap. It's the only fuel you know
Mr.
which is declining in value.
You don't have enough of it, right, to power the world.
Yes. That's only because we haven't had policies to support it. If we had policies to support it 5-10 years ago, it would be everywhere. You'd see the global warming budget start to come down. Now, we've got 5 or 10 years to make a huge difference. I need policy leaders all over the world to appreciate now, okay, big business is transacting with green hydrogen in multi-billion-dollar agreements. We now know it's here and it's here to stay. Let's spread it everywhere.
Coming up on the program, the hydrogen revolution. We'll speak with the CEO of Italian utility firm Snam about his new book and why he thinks green hydrogen will be competitive in just 5 years. Plus, how are airlines working to become more sustainable? We'll look at how Airbus plans to step up in the climate fight. This is Bloomberg Green. From Bloomberg's World Headquarters in New York, I'm Kaylee Lines, and this is Bloomberg Green. What will the world look like in 2050? Will global temperatures have stabilized, electric vehicles be abundant, and solar and wind power homes around the world? According to Marco Alvera, the CEO of Italian energy company Snam, that vision of the future could be a reality. And he says that hydrogen will pave its way. As he tells it in his new book, The Hydrogen Revolution, Alvera's moment of reckoning came in November 2018 when he tasked the Snam Scenarios team with studying how Europe could reduce its CO2 emissions to zero by 2050. Looking through the results of the study, Alvera said he was struck by how much hydrogen was in Europe's energy mix by that year. Beyond the abundance of hydrogen, the SNAM model also predicted that it would be the cheapest form of decarbonized energy for many sectors, and that it could be cheaper than today's prices for oil, coal, and nuclear power. Our Maria Tadeo spoke with Alvera at COP26.
It's happening all very fast. We see the cost of hydrogen coming down a lot. Hydrogen will play a big role in the energy mix. I don't know if it's going to be 15 or 25% of a fully decarbonized energy system, but it's going to be big. Costs are coming down, and people are waking up to the fact that it's the only way to decarbonize certain sectors, the so-called hard-to-abate sectors.
And you say it's the only way and the costs are coming down. Where do you see prices moving? Because a lot of the reticence at times has to do with the pricing, that some argue, well, it's still not the cheapest option on the market.
So when I was first working in hydrogen in 2004, it was costing $1,000 per megawatt hour. 2010, $600. Today, $100, and we see it going down to $50 in 5 years' time, and to going down to $25 per megawatt hour in the next 10 years or so, which is a quarter of where it is today. That's really because renewable energy, and we're talking green hydrogen here, renewable energy costs are falling, but the cost of making the electrolyzer, which is the kit that you use to convert solar or wind energy and water into hydrogen, the cost of this kit is falling a lot because it doesn't really exist on an industrial scale. So as we build up capacity, we industrialize it, we standardize it, and we squeeze costs out. That's really the cost trajectory.
And for that, of course, you need demand, however, for governments and also institutions to kind of buy into this idea that it is the future and we want to invest and create infrastructure. What are they telling you? When you speak to governments, when you speak to officials, are they keen on this?
They're very keen. So the Department of Energy shares our view in the States of getting to below $1 a kilo, which is $25 a megawatt hour. The European Union has a hydrogen strategy, which is very clear, and several member states have the same. Chile wants to export a lot of hydrogen. China's big on hydrogen. Australia is very big on hydrogen. Japan is blending already hydrogen. So I would say the world is now really focused on this because it's the only way to store energy for a long period of time economically is to convert it into either a liquid or a gas.
And of course, you talk about the price, but the other big component is the volume. You know, how big can you go? Where do you see that on a time scale?
So wherever it's sunny or windy, you can produce very cheap hydrogen eventually. And so compared to oil and gas, which are concentrated in few parts of the world, it's going to be very democratic from that point of view. So every sunny place, every desert, every ocean wind can be turned into hydrogen that we can put on ships, in pipes, and really start trading it around the world. So it's going to happen a lot faster than a lot of people think.
So, and when you say a lot faster, what is that in time?
As I said, $50, which is essentially oil parity within 5 years. And then, depending on how quickly we ramp it up after that, we could get to $25, which is coal parity before the end of the decade.
And in big scale.
In big scale, because once you get to coal parity, that's the only way we're going to get China and India to stop burning new coal. We have businesses in China and in India, and I see a lot of hydrogen development, a lot of renewable development in both countries. The India announcement was incredibly strong on 2030. Some people were upset about the 2017 net zero deadline, but when it comes to 30, he announced a big commitment to get to 50% renewables.
Were you surprised by it?
I was surprised that they would make it so explicit, and even the net zero is a big thing for them. And so I think it will happen faster than 2070 because of the falling cost of renewable and hydrogen. India's burning 80 gigawatt of oil, of diesel, to keep the lights on. So there's an immediate opportunity there, and we're very interested in working with that country.
And with regards to China, perhaps the fact that we haven't really seen them active, I guess the diplomats are working on this, but we haven't really seen the leadership.
It's going to be technology, it's going to be industry. I think China has committed to a net zero, which is very important. At the G20, China was clearly behind the 1.5 degrees. So I think a lot has been achieved between the G20 and COP, and I think what's really important is to see in the coming years how quick. It's in our hands to make part of this happen in 5 years, or it could otherwise happen in 15, 20 years. It's about building the project. The capital is there. We saw how many trillions of dollars are already committed. What's missing is really the projects, and that's where companies like us step in.
Marco Alvera, CEO of SNAM there, speaking with our Maria Tadeo. Let's turn now to the aviation industry. It's a big contributor to global greenhouse gas emissions, and it's under pressure to change that. In October, the International Air Transport Association, a trade body representing airlines, approved a target of achieving net zero emissions by 2050. To achieve that, many airlines in the US and Europe are looking to buy sustainable aviation fuel made from renewable sources like used vegetable oil. Initiatives like these are pushing plane makers to come up with some radical new aircraft that will eventually cater to our growing appetite for travel without hurting the environment. We took a look at how Airbus, the world's #2 aircraft manufacturer, is stepping up to the challenge.
How long until we can fly emission-free? Airbus says it's more confident by the day it can be done by its 2035 target. Airbus's CEO spoke about its ambitions for hydrogen-powered planes at the company's summit in France.
The physics works. Hydrogen technologies are not new. They are used in other sectors. We use them in space on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes. So every day we become more confident, but we think we need to have a plane, we need to have the right fuels, the hydrogen available in the right quantity at the right place at the right time, and we need the regulations to be ready. So we really need the work and the collaboration of many people around the globe to make it happen on time.
But it could be a long wait until green passenger jets go mainstream. Larger aircraft with more than 150 seats are not expected to feature globally until about 2050. That means manufacturers and airlines today are under growing pressure to ramp up short-term innovations to cut their carbon. In the long term, meeting the ambitious plans for so-called green hydrogen means building a giant industry almost from scratch. To make that happen, British airline EasyJet is among those saying governments need to get involved and fast. Aviation's emissions over the last 3 decades leading up to the pandemic grew by about 80% to over 1 gigaton, and that's projected to double by 2050. According to Bloomberg NEF, about half of the airlines with the largest global market share have set net zero targets by that same date, nearly 3 decades away.
Coming up, from blue sky projects to the bottom line. We'll speak with our Bloomberg NEF expert Meredith Annex and dig into their models about how hydrogen fits into the future energy mix. This is Bloomberg Green. From Bloomberg's World Headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. Now let's bring in Meredith Annex, our Bloomberg NEF hydrogen specialist, to talk more about how hydrogen could change the energy landscape. So Meredith, what place do you think hydrogen is likely to have in the future energy mix globally?
Hydrogen's this incredible solution for us as we look to decarbonize because it's a perfect solution in areas that are hard to electrify. So where we like to think about hydrogen playing a role, it's in things like heavy industry, especially where you need a feedstock as well as energy source, and in things like dispatchable power, long-haul transport, maybe even shipping and aviation.
That sounds great that it can be used for such diverse industries. At the end of the day, though, how much is this going to cost?
Well, that's the amazing thing about hydrogen, because depending on how you make it, it can actually see significant cost declines in the future. So when we're talking about clean hydrogen, we usually mean green hydrogen produced from renewable electricity. And in that case, your hydrogen is almost as cheap as the renewables that are used to make it. So if you're in a place with really good renewable resources, you'll be able to have cheaper hydrogen. But even in places with less good resources, we think that hydrogen can be cheaper than $1 per kilogram, which is the price of unabated hydrogen today, and around $8 per million BTUs for those who prefer to think in energy units. And that can be achieved anywhere in the world by 2050, we believe.
All right, so let's talk about kind of the pros and cons list. I don't know where cost fits into that, but what are the advantages to hydrogen over other renewables, and then what are the drawbacks?
Yeah, main advantage is the fact that hydrogen can serve roles that electrons struggle with. And that's things like seasonal storage, for instance, or just anything where you need storability, where electrons are harder to store, hydrogen is going to be easier. That also leads to a downside, though, because hydrogen is less energy dense than the usual things that we use for storable energy today, like coal or oil or natural gas. So you will need more volume of storage to handle the same amount of energy.
Let's talk about the viability as well and how it may differ in different geographies. What is your view on that?
Yeah, so for green hydrogen, again, from renewable electricity, really places with the best renewable resources, things like Latin America or the Middle East, even Southern Europe, have really, really good potential for producing hydrogen. And then when you're looking at blue hydrogen, which is produced from natural gas or coal with carbon capture and storage, we do see that becoming more expensive than green hydrogen in the future, especially as renewable electricity costs come down. But that can be a viable option in places like the US Gulf Coast or Russia, where you've got good geological storage for the carbon, as well as ample natural gas that's quite cheap.
All right, great breakdown. Thank you so much to our Meredith Annex, our Bloomberg NEF hydrogen specialist. And of course, you can get more from the Bloomberg NEF team on the terminal and online. And they've recently done a podcast called Hydrogen 101 as part of its Switched On series. So from iron ore titans pivoting to cleaner energy to talk of a hydrogen revolution, that's it from this week's edition of Bloomberg Green. We'll be back next week with a deep dive into the state of electric vehicles. And you can keep the conversation going by following us on YouTube, Instagram, and Twitter @Climate. I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and this is Bloomberg Green.
Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
All right, live from the Bloomberg Interactive Brokers studio, streaming on YouTube and Bloomberg Quick Take. Sorry for all you triskaidekaphobians out there, but it is Friday the 13th.
I had to Google that.
Really?
Yeah.
I've used it before on you.
How to say
so
it?
glad you listened to me.
Well, I'm not going to say it. You're the one who says it.
I lived on the 13th floor in college, and so when you came off the elevator, we had this big sign, triskaidekaphobia.
Oh, okay.
Yep.
Well, that's a good word for you using college.
Fear of 13. All right. Looking at the S&P right now, it's on track for a second week of gains despite some earlier pressure from the bank stocks, which have, as we know, Tim, they've done a 180.
Yeah, following a round of earnings, bank stocks doing that 180 you mentioned, Carol. We're going to have more on what the banks are doing in the overall trade in just a minute.
We're also going to talk about how Goldman lost $1.2 billion in just 9 months. That's a big loss.
Plus Tesla slashing prices. It's having repercussions across the auto industry today.
What's up with that? We're also going to talk about being a woman in STEM. I am so looking forward to this. Cisco Executive Vice President, Chief Strategy Officer Liz Santoni stopping by, see what she has to say. And then WTF ETFs. Where are the women? We've got the firm working to change all of that. Yes, I said it.
All of that to come, plus more over the next 3 hours. We begin, though, with a check on the trading day and Doug Krisner.
So what's the term for fear of you stealing my thunder? I was ready to talk about the big banks today, and you're right, Carol, we have seen a big turnaround, kind of a whipsaw here. Let's begin with J.P. Morgan. The company gave a disappointing outlook on net interest income early in the day, and that seemed to set the stock a bit on the back foot, although J.P. Morgan shares right now trading higher by about 2.5%. Wells Fargo saying earlier it set aside more than was expected for potential soured loans. We have shares in Wells right now trading up by about 2.5%. Citi reporting fixed income revenue beat, but revenue for the current year, 2023, is going to be a bit below forecast. That may be causing a little bit of alarm, but nonetheless, Citi shares right now higher by about 1.8%. Banks typically effective predictors of how the economic landscape is progressing. So we're seeing a move up in Treasury yields, kind of curious. 10-year now at 349 with a gain of nearly 6 basis points. In terms of equity price action, the Dow is ahead 0.2%. Similar gain for the S&P, NASDAQ comp higher by about 0.4%. I'm Doug Krisner. That's your Bloomberg Business Flash.
All right, Doug, thank you so much. All right, let's get to the market drivers report. Let's set your business week agenda on this Friday the 13th. Ooh, is that ominous? Should we be afraid?
A little spooky, Carol.
Kriti Gupta, anchor and markets correspondent here at Bloomberg. She's in our Interactive Brokers studio. Out there on the phone in White Plains is Vince Signorella. He's global macro strategist at Bloomberg News. Kriti, let's kick it off with you. I feel like it's been a tale of two markets today.
It kind of has, and I think this move that you are seeing right now is kind of interesting because it's not really a conviction move, but it kind of has been all day. And here's what I mean by that. The stock market did drop pretty significantly earlier on in the session, and a lot of that was driven by financials. It was the worst performing sector at the opening bell this morning, and that kind of makes sense with some of the not so great numbers that we got from JP Morgan, Citi, and the other banks that reported. I don't feel like going through the list, but the idea here is simply being is that all those macroeconomic headwinds that their trading houses had kind of helped them stay afloat on has kind of caught up to them. Now, the downside of this is that it affected the whole market, one from a weighting standpoint, but also because you had Tesla as well, and their big price cuts also weighing on the market. But I think the turnaround story has been really interesting, and I think Vince Signorella is a better person to probably comment on why the turnaround happened. But he basically, this kind of move higher, I think, is more interesting because even though the S&P 500 is only higher by about 1/10%, it has actually, and I'm just going to give you the number very quickly, as well, but it has actually pared back almost, what am I looking at, 0.6% of a loss. So that's pretty good, I would say, on an intraday basis, especially before the long weekends.
I'm going to put this out there. JP Morgan is about 1.25% of the S&P 500. As for Tesla, it's not even 1%. So,
anymore.
Right. Yeah.
It used to be.
Exactly.
A few months
but I'm just
ago.
saying in terms of like, what's going on here a little bit more in the market.
It did lead to other car companies moving lower too that are in the
Yeah,
S&P, including
right.
Ford and General Motors as well. Again, small fractions of the overall index. Hey, Vince, come on in here and kind of answer that question that Creedy put, which was why the reversal? And I got to tell you, I'm just a little surprised that we didn't see more of a reversal when those UMich sentiment numbers came out, because they were looking pretty good.
Yeah, and I think the UMich numbers are exactly what was a big part of this reversal. We saw brilliant sentiment numbers and lower inflation expectations. And, I would add in that Tesla situation does bode well for inflation for this year, because if you are seeing lower auto prices, you are going to see lower inflation expectations. That's a big part of consumer expectations. I think when you're looking at the price action so far this year, you're looking at a brilliant setup for the first quarter in terms of where this market is going. The only thing knocking down that traders are selling on is when we see the hawkish Fed speak. And very quickly after that, we see the market turn, go bid, and they're buying dips. And I was talking to a trader this morning, and he said big put buying very early on, reversed very quickly after UMich, big call buying, and traders are buying dips and selling the VIX, and they're liking this a lot. So I think looking at the first quarter, I like the way this is setting up in terms of a bull market. And I think finally, we've been talking about this in September, at least, I've been beating the Fed that they should be done. And I think finally the sentiment among a lot of the pundits on the street is that perhaps February and then done for the year.
So
Wait, hold on. February and then done for the year, Carol? I mean,
could be. Well, so Vince, wait, yes, because you've been saying, come on, Fed, stop already. Would you concede that they might just get this right and engineer a soft landing?
I'm not so sure about the soft landing, but it depends on where they go from here. If they stop in February, yes, there's a real possibility that we get a very, very mild recession. We come out of it on the bright side. In fact, we may not even get a recession. But you still have people like Bullard pounding the table, wanting another one and another one, and another one. If you look at inflation, and if you look at when the Fed started, so the Fed started roughly in February, inflation began to moderate and peak in June. 4 months after the Fed altered monetary policy, inflation expectations changed. That's in line with monetary policy sentiment. Usually it's 6 months, so 4 months is fine. They need to realize that monetary policy is working its way through the system just brilliantly. We're seeing it in housing. We're seeing it in lower inflation expectations. Let it run its course. They've done more than enough. Inflation over the last 30 years has averaged 2.5%.
Okay, Creedy, come on in here. Oh, sorry, Vince. You were saying?
No, I was just going to say. So we end up at 3%. What's the big deal?
Okay. Creedy, I want to just give you the last word here. So we made it through a handful of big bank earnings. We got, just the start of earnings season. Got a lot of economic news next week. What's the most important thing for us and for our investor audience?
Next week, yeah. Well, I would argue some more of the bank earnings, honestly, and some like the earnings story altogether, because I think we're
Goldman
not
on
actually
Tuesday.
Right, Goldman on Tuesday, but I also think you have to look at some of the other companies that are reporting. For example, airlines came out. American Airlines came out yesterday. Delta Airlines came out today with two very different messages. American was saying, look, we don't think the travel demand is going anywhere. Delta said, well, actually, we're missing our profit forecast here. So they're really getting punished today. And I think that divergence is crucial, because that's going to be a bigger and bigger theme going into earnings season, which is why it's so hard to say, is this earnings season really going to be that successful? I say look more at the micro than the macro.
I was just going to say, look at each company specifically, especially when you have something like an American versus Delta coming out with some very different stories. Creedy, thank you so much. Creedy Gupta, anchor and markets correspondent at Bloomberg in our Interactive Broker studio. And our thanks as always to Vince, global macro strategist at Bloomberg News. He contributes to the Macro Squawk Desk, which you can find out. Just go SQUA Go on our Bloomberg Launchpad.
All right, let's talk more bank stocks.
Let's do that.
All right, well, as a whole, they were lower, now they're higher. So this first hour, we're looking at a group in a couple of different ways. First up, Carol, this morning's earnings and updates on the business from JP Morgan, Bank of America, and Citigroup. but had stocks moving lower, at least initially.
Yeah, and after bank stocks, keep in mind, underperformed the broader market last year. There were many who were saying that this group is potentially primed for a bounce higher, and we ultimately are seeing that in this latter half of the trading day when it comes to bank stocks. KBW Bank Index was up more than 9% from December 20th through yesterday, but it's even more now with the bump up today. So let's get to it. Anton Schutz is back with us. He's President and Chief Investment Officer at Menden Capital Advisors, joining us via Zoom from Florida. Anton, good to see you. Happy New Year.
Happy New Year. Always happy to be with you.
Well, always great to have you here. So quite an interesting day. They came out initially, those bank names, those big bank names were under pressure in the equity trade. They've turned around. As I always like to do and start with you broadly, what jumps out in terms of what we got from results today?
Oh, I think we got kind of what was expected, right? Sort of maybe near the end of the net interest margin, very weak investment banking, FIC that was okay. It was really the conference calls, I think, that turned the stocks, because I think that the stocks, underperformed last year. People were really afraid of bad credit, right? 2007 all over again. And as I've said on your show many times, this is not 2007. These are not the dumb bank CEOs making really terrible mistakes with bad products, because they really did in 2007, right? They negative amortization mortgages, and they were lending anything that moved. I mean, these guys who run these banks today, they've learned a lot of lessons. They understand risk and risk management, credit underwriting, and they are not where the bad loans are. And what's interesting is obviously maybe the end of the interest rate margin expansion, but they've had that expansion, right? To go from zero rates to where they are today, earnings estimates went up all year, yet the stocks went down. Now we may be in a scenario where earnings estimates may actually go down some, but the stocks are so cheap relative to where the rest of the S&P is, the stocks could actually outperform, and value has certainly been showing that.
Anton, it's interesting because even if this year is looking good, we still saw all of the lenders put aside more money to cover loans that might go bad. How do you read into that?
Well, first of all, it's this crazy accounting thing called CECL. So, the banks all have to buy a model from Moody's, and obviously they have their own models as well. But, you have to take in all these factors, and those model-based factors tell you that credit is going to get worse. They're not seeing it, right? It really hasn't happened. I mean, on the margin, we've seen credit get worse in the subprime consumer. The banks really aren't in that space. We're certainly seeing, on the credit card side, people are spending more, they're not paying back as quickly, but they're not defaulting. They all have jobs. I mean, I think another big factor is everybody has a job. Everybody wants a job, has a job. And, employers are still scrambling to hire people.
So what do you make too of, one of the things, Anton, no doubt about it, that we wanted to see the results and what how the banks came in. We were really interested in outlook and what the CEOs had to say. Any consensus takeaway for you? Jamie Dimon, of course, we parse every word that he says, but was there any takeaway for you among the big bank CEOs today?
Yeah, I mean, he didn't use the word hurricane.
Right.
Thank goodness. I think he's regretted that word. We all have. Anybody who owns financials have regretted that word. But the reality is they're all, sort of cautiously optimistic, right? Nobody is negative. No one's going, oh my goodness, things are going to be tough. Now, nobody likes the pressure that's out there. Maybe the Fed is done, right? Your prior guest talked about maybe them being done. Maybe they're close to done, and maybe we can engineer a soft landing. Even if there is a mild recession, banks have outperformed during mild recessions. If you look at that period, and I guess I'm giving my age away, but I ran money in that 2000 period where the dot-com bust happened, and financials performed very, very well. And you may have that value, outperformance versus growth. You may have that mild recession where banks do not lose a lot of money. They don't lose money at all. Because their underwriting has been so good. And by the way, the other thing is we've talked fintechs on your show.
Yep.
Fintechs don't have deposits, right? The neobanks, they really don't have good deposit, good cost structure. Look at Goldman Sachs, right? Is it a bank? Well, it's an investment bank. And their cost of funds is very expensive. They've lost a lot of money, for going into this consumer segment. Banks that have true core deposits, checking and savings accounts, actually benefit from having stable funding, from being regulated, and they actually can go back and take market share now because the people who don't have that funding cannot compete.
So, go ahead, Tim.
I was just going to ask about the American consumer, because that's one area that we really like to hear from big bank CEOs on, and oftentimes there's a lot of commentary about it. How would you characterize what we heard from bank CEOs regarding the American consumer, their cash position, and how much money they have to be able to pay for stuff that is more expensive?
Yeah, I mean, the cash position's still better than pre-crisis. They're certainly spending. They're not saving a lot. I think that's, the savings rate is where we're starting to see some stress, but the cash levels at consumers are still in pretty good shape. You can see it in the credit cards, like I said earlier, that they're not paying them off as quickly, right? They're using their cards and they're borrowing, and they're not paying them off as rapidly. That's very different than defaulting, but there's no doubt that at least the consumer has a job, and lack of jobs is what really causes trouble in consumer lending.
All right, so we know when we check in with you, you always like the regional bank space. I'm assuming you still do. That's where your fund and investments go. What in particular, or what's the outlook for regional bankers at this point? Is it tougher? Is it tougher for them in a mild recession?
No. It isn't, and I think I've talked before about markets that are favorable, right? You've seen a lot of people and businesses move to places like Texas and Florida and Tennessee. So those markets can maintain above national growth metrics. First of all, second of all, a regional bank, particularly a smaller bank, can really know its customers, right? The underwriting becomes a lot easier than going out and underwriting very large multinational companies. So, you actually can understand that customer, do a better job of underwriting. But I think what's really important is, again, going back to deposits, and regional banks that are very well funded really can outperform because they can take advantage of these higher rates, right? Margins could still rise. I've got companies in the portfolio that trade at, have 60% loan to deposit ratios or 80% loan to deposit ratios. Means if they can lend out that other difference to a loan, or even buying a security at a higher yield, their margins continue to improve. So, those are the types of companies that are becoming much more valuable to those that don't have deposits.
If you had one,
it's interesting.
Ooh, sorry, go ahead.
Go ahead.
No.
Well, so if you look at the Northeast generally, a lot of the banks in the Northeast have loan to deposit ratios that are closer to over 100%. So right. they don't have that room.
Hey, Anton, just got about 40 seconds left here. So if you had one name that you feel pretty confident about for 2023, what might it be?
Well, I'm going to First Bank. FBMS is the symbol. It's one of the largest positions in my fund. And, I think they have that optionality that I really like. I think they're a very attractive franchise. I think they do have a 60+% loan to deposit ratio, so in good shape there. 30% of the bank is in Florida, 30% is in Georgia, so good growth, even though they're headquartered in Mississippi. And at the end of the day, there's a lot of bigger banks that would love those deposits. But also, they've been a very smart buyer. They've added a lot of value to that company over the years.
All right, we're going to leave it on that note. Hey, so great to check in with you and really appreciate what is obviously a really big day when it comes to big banks. We know it continues into next week. Anton Schutz, thank you so much. President and Chief Investment Officer at Menden Capital Advisors, joining us via Zoom from Florida. And, once again, if I look at some of those names, even something like a Morgan Stanley that reports next week, it's up 1.25%. And then we have Goldman. Let's see what it's doing as we speak. It's up about 0.8%. But really, those that reported today, quite a rally we're starting to see. This is Bloomberg.
Headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
We've seen a turnaround in the equity market. We began on the back foot this morning after the big banks, a number of them, reported outlooks that were a little worrisome, I think it's fair to say, particularly in the case of JP Morgan with a disappointing outlook on net interest income. But Morgan shares have recovered and right now pushing higher by roughly 2.5%. The S&P Financials Index right now with a gain of about 0.6%. Bank of New York Mellon is planning to cut about 3% of its workforce this year. That would equate to about 1,500 jobs. The aim here is to streamline expenses. Now, many of these reductions, we are told, will target management positions. Bank of New York Mellon shares right now higher by about 2.4%. Take a step back, look at the overall equity market. We have the Dow higher by 0.1%. Similar gain for the S&P. NASDAQ comp rising about 0.2%. Shares of Tesla on the back foot right now. The automaker has cut prices as a way of boosting demand. And United Healthcare shares showing a bit of weakness, even though adjusted EPS was above estimates. And United Health also seeing a minimal cost uptick from the flu and other respiratory virus situation in Q4. I'm Doug Krisner, and that is your Bloomberg Business Flash.
All right, Doug, thank you so much. Doug Krisner there. Well, you know, we are all over the big bank earnings today. We get more next week. But this is the most read story on the Bloomberg in the past 8 hours. It's about how Goldman lost $1.2 billion, Tim, in just 9 months in its newest unit. Yowza.
Well, with the story and the outlook for Goldman, we got with us Bloomberg News finance team leader Sally Bakewell. She's right now in our Bloomberg Interactive Brokers studio. Okay, so it's the newest unit, Sally, $1.2 billion in just 9 months. The Apple Card?
Yeah, so this is the current incarnation of David Solomon, CEO's effort to turn Goldman Sachs into a kind of bank for the everyman. And he's spent much of his past 4 years atop Goldman pitching shareholders, his own executives on the benefits of building this full-service digital bank. And then he spent much of the past year reeling in those aspirations and dialing down those resources dedicated to the project because of cost overruns, missed profitability goals, set off a lot of discontent in the firm.
What's so difficult about this? What is so expensive about this? And I mean that.
Tim, you go and do it.
I'm not saying I can do it, but there are plenty of banks out there. There are plenty of banks out there that do serve the consumer and serve a wide variety of consumers.
I think they had a lot of questions from regulators about cost overruns of setting up a business, and I think trying to deal with the things that come with a consumer unit, such as litigation or delays in payments, I think possibly Goldman wasn't entirely set up for, or ready for.
Okay.
So is it just a matter of time that it will work out, or TBD at this point? Like, are they giving up? I mean, we've seen them pare back on some, right?
So they're not entirely giving up. So they wrapped a lot of the business and the consumer business into one unit about 3 months ago.
Right.
And so rather than just catering to anybody, Goldman put some of its key consumer products through its wealth management business. Checking accounts, which were once widely expected to be a big part of the rollout to the masses, will instead be kind of shunted towards the more well-to-do clients. And the same goes for the bank's robo-advisor, known as Marcus Invest, and its savings account. But I think the bank still plans for this new unit, which is called Platform Solutions, to achieve a kind of break-even status sometime in 2025. But that final target hasn't really been set.
So can we talk Apple Card? Like, it sounds like, talk about
Apple
iconic...
Card, not Apple Car, right?
Apple Card.
Because we do spend a lot of time talking about the Apple
We
Car,
do.
a potential Apple Car.
But I'm thinking, like, iconic brands, Apple, Goldman Sachs, right, in terms of, the big banks and Wall Street firms. It sounds like a tie-up made in heaven. Is it still? Because my understanding is that the division's $1 billion pre-tax loss reported for 2021 mostly tied to the Apple Card, according to those in the know. So I'm just curious, is there just something that hasn't come to fruition yet with this, or is it just not
working? I think that's a great question. I don't think the answer is entirely clear. A lot of the loss also comes from its installment lending platform, Green Sky. Installment lending was obviously fantastic during the pandemic, but it has faced a lot of also regulatory questions about the kind of debt burdens it puts on consumers, and the sort of shine came off it a little bit when people were able to go back to shopping in stores. So I think it's both Apple Card and this Green Sky installment lending.
Installment lending is, like a firm type of product, right? It's the idea of buy now, pay later.
Yes,
and
it's like the old layaway.
Exactly, but I mean, Sally, I remember, you're absolutely right. It was
everywhere.
Huge during the pandemic. Regulatory issues aside, what are we learning about the actual business, big picture of installment lending? Is it, are consumers having trouble paying this back yet?
I think that consumers now facing a variety of different forces, higher interest rates and inflation, are probably starting to struggle a little bit. And I think what happened was a lot of the sort of excellent seeming offers they were getting with a lot of these installment lending companies perhaps didn't turn out to be quite as consumer friendly as they thought.
So net, like it's been an interesting story to watch, right? And I think over the last how many years, a lot of fanfare, a focus, and then it does feel like the last year has been a very different tone, but they're still committed, as you say. And I'm just curious, David Solomon, does he need to be worried at all that this isn't going so well?
I think he probably does. It generated a huge amount of dismay among the firm's executives, and there was mounting pressure on managers to tackle the consumer unit's expenses, and it sort of bled into other areas of the bank. Whether this now is a fix will be seen, but obviously we are only getting bad news about the unit in terms of its losses. And don't forget, this is the first time since 2019 that Goldman has disclosed financials to this consumer business. So it'll be interesting if they, now that it has been integrated in this way, will have a much clearer picture of its financials going forward.
All right, so speaking of going forward, we've got Bank of America, Citigroup, Wells Fargo, as well as JP Morgan out of the way. It's been a long day for you. Next week, we got Goldman Sachs, we got Morgan Stanley. What does our investing audience need to be looking for, given what we learned from these four big banks that already reported?
Yeah, today was very much about the consumer. Investors were looking for economic kind of outlook. And, this morning, it looked like investors were very much prioritizing outlook and expenses above these sort of records that they were smashing. Citi hauled in its sort of record haul for its trading. Both Wells Fargo and JP Morgan posted the highest ever net interest income, but investors didn't seem to care about that. As the investor calls happened and executives discussed on conference calls, it seems that they've assuaged their concerns a little bit. And
that's what's kind of crazy, wasn't it? Like, I was reading through the numbers, and I'm like, they did okay. They made money, guys, right? Initially, when there was some selling.
Yeah, they were profit and revenue beats, but that didn't seem to be enough. I think there's too much concern out there about the health of the consumer and a recession and what it will do to curtail borrowing, which is the main business of banks.
That's what's puzzling to me, though, because we're also getting kind of some really good signals as well from the macro economy. A week ago, we got some really solid jobs figures. We got wage growth moderating, which is a good thing for the Fed because it's, no wage price spiral. Good inflation numbers yesterday, consumer sentiment today, inflation expectations at their lowest since 2021. I don't know. People are saying soft landing again.
Well, I do wonder, Sally, I've been thinking about the banks. Could it be that the Fed, raises rates a few more times and then is going to sit there for a while, right? And a certain amount of higher percentage of rates is a good thing, right, for banks in terms of what they can make. And if we do have that soft landing, so they could have growth with rates a little bit higher, it could be a really sweet spot potentially for the banks going forward, right? Like if the economy doesn't fall apart and yet they're making more off the net interest margin because of those higher rates, I was thinking this could be a really decent time.
No, absolutely. If people continue to borrow, they're raking
I'm waiting
in
for
more
rates to
at
come
higher
down.
rates. So that will be great for banks. I think it's a question of whether this is the peak a little bit, and as rate hikes mediate, the sort of benefit they've seen so far starts to recede a little bit, and we might see. I think what came out of earnings today is that they do expect an uptick in net charge-offs, in loan losses, but at the moment, a lot of those things remain at pre-pandemic or fairly stable levels. And a lot of what they're saying is that things will revert to the norm rather than get too much worse.
Talk about the theme of 2023, right?
What?
Reverting back to the norm.
Well, what it is, right? Like maybe as we start to kind of like things settle out post-pandemic. I was going to say something and I lost my thought.
It's because you have Friday the 13th syndrome.
I have
What is
Friday
that?
the 13th.
What's
triskaidekaphobia.
Yeah.
Oh, wow. A new word.
Thank you. New word for me, too.
Oh, I knew what it was. Our previous guest who invests in bank stocks talked about, good thing that, Jamie Dimon, he didn't use the word hurricane.
Yes, he's very specifically hasn't really used it since he said it, which perhaps tells us that maybe he regrets that a little bit.
Exactly. Thank you so much. We know it's so busy, but we really appreciate your insight and breaking down this story for us. Sally Bakewell, she's going to have maybe a break this weekend?
Maybe.
Definitely, but another busy week next week. She's finance team leader at Bloomberg News, joining us in our interactive broker studio. Sally, thank you. All right, you are listening and watching Bloomberg Business Week on this Friday. Carol Massar along with Tim Stanovic. We continue to watch the markets. We've got stocks pretty much at their best levels of the session. So percentage-wise, we're talking about NASDAQ being the outperformer, up about 0.4%, Tim. S&P up just shy of 0.2%.
Well, let's go to Washington, D.C. now for an update on world and national news with Nancy Lyons in the 99.1 newsroom. Hey, Nance.
Thanks, Tim. The two Trump companies that were found guilty of tax fraud last month have been sentenced to pay more than $1.6 million. That's the maximum fine allowed under New York state law, and it's a far cry from federal penalties for corporate crimes. Manhattan DA Alvin Bragg says harsher penalties need to be put in place.
We're calling for the law to change so that this type of a fraud will be acknowledged by the law and that there'll be a real deterrent by monetary penalty. So we're calling for that, and we'll be working with our partners in Albany.
Manhattan DA Alvin Bragg, the former president, still faces a $250 million civil fraud suit from New York Attorney General Letitia James. The U.S. deficit is nearly half of what it was a year ago. The federal budget deficit in 2022 sat at $1.4 trillion compared to $2.6 trillion the year before. The Treasury Department attributes that to the economy reopening after COVID lockdowns. A deadly storm system spawned tornadoes across parts of the U.S. It was mainly in the deep south, killing at least 9 people and causing substantial damage in the historic city of Selma, Alabama. James Perkins is that city's mayor.
The governor has already committed to doing a declaration of emergency, and also we've gotten commitments from Washington to get the support that we need.
Selma Mayor James Perkins. The National Weather Service says tornadoes touched down in nearly 20 counties. The NFL Super Wild Card Weekend gets underway tomorrow. Saturday's playoff action will see the Seattle Seahawks facing the San Francisco 49ers and the Los Angeles Chargers battling the Jacksonville Jaguars. Sunday will see a triple header, followed by the first round action wrapping up Monday with the Dallas Cowboys taking on Tom Brady and the Tampa Bay Buccaneers. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
So the Fed meeting will kick off on the last day of the month. It'll wrap on February 1st. Yesterday on CBS News, we had the head of the Atlanta Fed, Raphael Bostic, saying he's leaning towards supporting a smaller interest rate hike at the next meeting. By the way, he is a non-voter. Then you get news today that U.S. consumer sentiment improved in early January. The University of Michigan index is now at a 9-month high. We're seeing yields move up across the curve, particularly at the short end here. Kind of interesting. 422 on the 2-year with a gain of more than 7 basis points. Then you look at the equity side, where it has been a day of volatility after the major banks kind of recovered a bit from some early weakness. That was tied to some worrisome outlooks. We had J.P. Morgan Chase, one example, giving a disappointing outlook on net interest income, and Wells Fargo setting aside more than what had been expected for potentially bad loans. Both stocks right now are up roughly 2.5%, and the S&P 500 Financials Index higher by roughly 0.6%. The Dow is ahead 0.1%, S&P better by around 0.2%, the NASDAQ Composite climbing about 0.6%. I'm Doug Krisner, and that is your Bloomberg Business Flash.
All right, Doug, thank you so much. You are listening and watching Bloomberg Business Week on this Friday the 13th, and the new issue of Bloomberg Business Week. Great way to spend the Friday the 13th. It's out. Find it at newsstands, online at Bloomberg.com/businessweek, and always on the Bloomberg terminal. And Tim, let's remind everybody it's the year ahead issue.
Yeah, and in the finance section, you find this great story by Max Abelson. He's Bloomberg News finance reporter. It's all about the young bankers who got used to smooth sailing and how they now are preparing for a storm. Talk about a sea change. Max joins us right now in our Bloomberg Interactive Brokers studio. You say young, but it's kind of like anyone under 40, Max.
Well, I resent the implication because I myself turned 38 recently. So my idea of what young is kind of changes.
We're the
as I get
same
older.
age, Max.
I did not know that, but you look so young.
Oh, thank you.
but it's true though. I mean, what we're really saying, young is essentially a euphemism for us, because what we're really saying is that if you started in this industry, any time after 2008, or let's call it after 2009, you have lived through this era where free money is essentially a fair phrase. Interest rates have been so low, by and large, since then, and the sailing has been so smooth, although obviously horrible things have happened, like COVID. But by and large, people have lived through an era that is sort of being replaced by something new, and that's what the story's about.
I do feel like it's been an era, right? You could kind of throw money at almost anything, it felt like, and things went up. And I feel like now the learning begins for a whole generation on Wall Street.
Yep. So I want to give a shout out to my co-reporter, Nick Corello, who's a great reporter. He found this guy, Drew Pettit, who is an analyst at Citigroup. I want to say he's in Buffalo, New York. Shout out to Buffalo, New York. And Drew basically realized that his life on Wall Street was so, essentially so even-keeled that he decided to give himself homework. I think that was the word he used. He decided to give himself homework and read basically the bleakest books he could find. We actually didn't print this, but I think one of them was Black Swan. I think one of them, I have a list. I'll send it to you.
But they were bleak.
Bleak books about bleakness, financial bleakness. And he really wanted to understand, I think at the end of the day, probably, these are my words and not his, but how to make money, when the times aren't good and money isn't growing on trees. And, it's ironic because the story was inspired. Paula Dwyer, an editor who edited our piece for Business Week, Paula Dwyer noticed this. A Citigroup executive, not one of Drew's bosses, but this is I think one of the top bankers in London. She gave this speech at a conference late last year where she said, I laugh to myself when I see these young people who are now making managing director. So I think that called out you're 32, you're 33. These people are becoming managing directors at my bank, and they've never lived through, anything but, an era of easy money. And I think she really implied that they're going to be in for a rude awakening here in 2023.
Well, you also do think that those banks or firms too also want to make sure that these guys have an understanding of what happens to assets in a very different environment.
Yep, it's so true. Sometimes reporting is it's not that it's a hassle, but sometimes reporting stories is so hard. You bang your head against the wall. And then sometimes, like to the contrary, things fall into place like so nicely. I was in what we call in the industry, or at least what we're going to do is an ed board, an editorial board. And I was sitting and listening to, it sounds boring because he's a regulator, Michael Su. So interesting. So much fun hearing him talk. He is the, I think he is the acting comptroller of the currency, But the guy was fascinating, and I did not ask this, but I knew we were working on the story, and without me saying anything, he said, it's funny because bankers are saying to me, Michael said, there are all these young kids working for me, and they don't know how to deal with all these crazy things.
Is there this layer of anxiety permeating right now among the bankers that you and your colleagues spoke to? Not just because of, it's not just burnout that you guys reported on over the last couple of years during the pandemic, but also look at the news we got earlier this week about Goldman Sachs, up to 3,200 people being laid off.
And that's a lot. That's a lot of people. Those are thousands of people. And it's not just at Goldman either, too, across the industry. I think anxiety is the right word. I think anxiety is the right word because, for one thing, we're hearing bankers talk about that. But for another, it's the right word because, we are not going through an awful era on Wall Street. After all, remember my story with Hannah that came out not too long ago. These big banks just made $1 trillion in 10 years. $1 trillion. So these are, by and large, wealthy people.
World, that's a lot of money.
In profit. In profit. So, I'm not taking out my tiny violin or my violin-shaped pool to refer to a very old story of mine.
I know that story.
But we are talking about an industry, though, that's where people are beginning to worry about just how drastically things are going to change and just how many jobs are going to be lost if this country and the global economy gets into as much trouble as a lot of people think it might.
No, I think it's so interesting. It's just like having a generation who's lived in a certain environment and we're maybe going into a very, very different one. And like, how do they adapt? How do they function? But I also do wonder, volatility and bad markets are also an opportunity where you can make still money, right? So it's like they've just got to figure all of this stuff out. It's really interesting. What surprised you most in you and Nick doing this story?
Well, without kissing up to you, let me just say that what you just said a second ago is so spot on. The idea that, and this was something that I think I had a kind of inchoate sense that this was true, the idea that when times are bad in the global economy or the U.S. economy, it is bad news for parts of Wall Street. It is good news for other parts of Wall Street. And Sally Bakewell, our team leader.
She was just in with us, yeah.
Sally, she helped us sort through the thinking. So it's like, okay, mortgages. You don't want to be in the mortgage business if interest rates are going up because people are not, the business is going to dry up and that will have knock-on effects. But then on the flip side, it's like net interest margin, which is a fancy way of the difference between what you earn on loans over here and what you pay depositors over here. That is good news. If rates are going up, that's good news. You don't want rates to be zero. If you're a trader, I bet you there are a couple of traders listening to this right now and chuckling to themselves because volatility is lucrative. You make money from volatile markets.
It's not bad to be a bank.
No, well, you can make it a lot of different ways. Yeah. Like, absolutely. I am curious to see how it all plays out. And I think it's interesting, too, Max, that the banks still feel confident to make these people, put them in leadership positions, knowing that they're going to be maybe going into an environment. Like, I think about that, right? These guys are going to be making investment decisions, trying to make deals. I don't know. Like, I am curious to see how it plays out.
Well, if there are any listeners here who are working for a bank and their bank is like taking them to this new, giving them classes on like how to deal with calamity, you know who you have to call. You gotta let me know about that.
Did anybody say that? Like off the record?
We're in calamity classes.
We're on the record right now, Carol.
Yeah,
well, I couldn't tell you if I heard it, but no, I did not hear about any calamity classes. But let me know, listeners.
You did mention a violin-shaped pool. An old article that you wrote. It's from 2014. We'll tweet it out. Ex-bankers upgrade the good life as violin pools beckon. So if you had that deep tease, go check out that story because it's another good one from
Thank you so
the
much.
Team, including Max.
But it's great insight in terms of the Wall Street culture, the financial culture, in terms of what's to come potentially, and what they're facing. Thank you so much.
Thank you.
All right. Have a great weekend. Max Stapleton, he's finance reporter at Bloomberg News, joining us in our Interactive Broker studio. You are listening and watching Bloomberg Business Week on this Friday. Carol Massar, Tim Stanovic. We are Bloomberg Radio.
It's now 2:53 on Wall Street. I'm Doug Krisner at Bloomberg World Headquarters in New York with a quick look at some of today's company headlines. We've been talking about four of the big banks reporting their fourth quarter results. Many have been above estimates. The outlooks are a little concerning. As an example, JP Morgan Chase gave a disappointing outlook on net interest income, and Wells Fargo is setting aside more than was expected for potentially bad loans. Bank of America's numbers were mixed. Trading revenue was better than expected. However, net interest income was lower than forecast. Citigroup reported its fixed income revenue beat estimates for Q4, and Citi also sees total revenue for 2023 above a forecast of $76 billion. Meantime, Bank of New York Mellon is planning to cut about 3% of its workforce this year. That's around 1,500 jobs. Shares in Tesla are lower after the automaker cut prices to boost demand, and United Healthcare reported adjusted earnings above estimates. Delta Airline forecasting first quarter profit short of estimates. Higher costs are dealing a blow to the carrier's effort to further capitalize on a rebound in air travel. And separately, Treasury Secretary Janet Yellen saying today that her department will begin taking special maneuvers on January 19th to avoid breaching the U.S. debt limit. She is urging lawmakers to boost the debt ceiling to avert a disaster. Those are some of the company's stories making news. I'm Doug Krisner. This is Bloomberg.
This is Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
It is Bloomberg Business Week. Let's get a check on the latest world and national news. For that, we go to Nancy Lyons in the 99.1 newsroom in Washington, D.C. Hey, Nance.
Thanks, Tim. Treasury Secretary Janet Yellen says her department will begin taking extraordinary steps to avoid breaching the U.S. debt limit beginning January 19th. In a letter to Congress, she says it's unlikely cash and extraordinary measures would be exhausted before early June. But White House National Economic Director Brian Deese says it should not get to that point.
This is very simple. This is not about new spending. This is not about new investment. This is about the United States government honoring the obligations that prior Congresses have already made. It's a sacred obligation, the full faith and credit of the United States.
White House National Economic Director Brian Deese spoke with Bloomberg. House Republican leaders say they will insist on spending cuts in return for agreeing to boost the debt limit. The FAA is out with preliminary findings on that computer failure that prompted a halt of U.S. flight departures. The agency says it was caused when a data file was damaged as a result of a failure to follow government procedures. According to the FAA, unspecified personnel were responsible for corrupting the file. Transportation Secretary Pete Buttigieg is seeing his political fortunes take a hit after the string of travel meltdowns.
This week's FAA system outage and nationwide ground stop came just weeks after Buttigieg faced questions over his handling of the holiday meltdown for Southwest Airlines. Republican Senator Tom Cotton has seized on both these issues, tweeting that Buttigieg couldn't organize a one-car funeral. But Democratic strategists say Buttigieg has helped himself in recent days by making appearances on cable news to explain what's going on. In Washington, I'm Nathan Hager, Bloomberg Radio.
A massive lottery jackpot could be won later tonight. The Mega Millions drawing is now worth $1.35 billion. The cash option sits at just over $700 million. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. Back to you, Carol and Tim.
Thank you so much for that update, Nancy Lyons. Bloomberg Business Week is brought to you by Innovation Refunds. This is your daily reminder from Innovation Refunds to apply for a payroll tax refund if your small or medium-sized business was impacted by COVID-19. Innovation Refunds clients have already claimed over $2 billion in payroll tax refunds. Get started at getrefunds.com.
All right, as you know, we've been talking about it. The year ahead issue of Bloomberg Business Week is out. It would not be complete without a peek into the worlds of luxury and culture. And with that, Tim, we've got Bloomberg Business Week arts columnist James Tarmy.
This is historic.
I have to say that I was kind of shocked when I went maybe right after COVID and the transformation had been kind of complete. It had been in the works for years. As I say in my piece, it's not just one thing, but if you were to trace it back, you can see this huge infusion of capital from the city's luxury barons. François Pinault, Bernard Arnault, then the Cartier Foundation, then the family behind Galeries Lafayette, the department store. All of these people have been pouring money not just into the art world, but specifically contemporary art. And that sort of fed this ecosystem of not only art galleries, but also art fairs, also contemporary art exhibitions, and then also artists themselves. And that sort of recreated the Paris that people think of in the sort of 1920s, which is this thriving art scene with artists and dealers and collectors and parties. And all of that has actually come roaring back in a very, very recent time period. And now the question that I wrote about is how they can sustain this kind of energy. And I actually think that the city can, because they've got the foundation at this point.
That's Business Week Arts columnist James Tarmy. Hear more of that and the whole weekend show and podcast, but the show, 8 a.m. Wall Street time on Bloomberg Radio. Coming up next, Bloomberg's Countdown to the Close, starting now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. About 60 minutes left to go in the trading day and the week. Romaine Bostic here alongside Katie Greifeld. We're joined right now by our colleagues Carol Master and Tim Stenovic. Welcome to our audiences across Bloomberg Television, Radio, Quick Take, as well as on YouTube. Happy Friday. Carol, a day that started off like it wasn't going to be so happy. Most stocks were in the red. They flipped into the green. I guess most people will take it.
Maybe Friday the 13th isn't such a scary one. Happy triskaidekaphobia, by the way, everyone. I'm looking for outperformance. You do that. All right, in the meantime, I'm going to take a look at some outperformance, and I found it in those Chinese names that trade here in the U.S. Don't judge me. But nonetheless, the group is up about 2.6%, up nearly 80% since late October, up about 19% or more so far this year. I haven't checked the latest numbers. But take a look at some of the specific names. Pinduoduo, top of the NASDAQ 100. It's up almost 4% today. Alibaba is also up about 3.3%. Couple things, government talking about taking some what they call tiny stakes, golden shares in names like Alibaba and Tencent. So looking like Beijing wants to take more control. You also had China exports slumping even more in the month of December. So some negative news, but nonetheless, you continue to see optimism in this group.
All right, well, you're not seeing optimism when it comes to autos today. It's one area that's lower. This all because of Tesla. Look at this. Tesla down 2.3%, but the companies that are actually more affected are not Tesla. Ford down 5%, GM down 5%. We got Rivian down 7.6%. This is all because of Tesla slashing the price significantly on its cars, not just in China, but around the world. This is an effort to boost demand in what's typically a sluggish winter quarter. Investors not so happy about that and a little concerned about what it means for other car companies too.
Yeah, meanwhile, though, I mean, investors are finding some solace here in the latest economic data, as well as some of the early earnings reports that we've gotten, pushing the S&P 500 back to 3990. We should point out at that level, that actually puts it about 8 or 9 points above its 200-day moving average. We'll see if it can hold that and close. The Dow Jones Industrial Average also higher fractionally on the day, as is the NASDAQ and the Russell.
And you look at the sectors, you've got more green than red. 8 sectors higher right now, led by financials, up 0.6%, vying there with consumer discretionary stocks. You're having a good day for Amazon. That's helping out that sector. You look at what is not working today. It's industrials down 0.4%. Also, real estate down about 0.4% as well.
Yeah, well, when you talk about some of the individual movers here, and what I've been calling some of these stealth rallies here, Amazon shares up almost 3% here on the day. In fact, it's now on its longest daily win streak, going all the way back to July here, and headed for a gain, at least on a weekly basis, I think, of around 12 or 13% here, which is going to be its best showing in more than 2 years. Meanwhile, the flip side of that is Northrop Grumman, which is down something like 12% on the week. That includes a 6% drop here on the day. Still a lot of concerns out there right now about potential budget cuts in Congress after Kevin McCarthy made that deal to become Speaker. Budget cuts that may target military spending. Delta Airlines shares also moving lower here on the day after it gave a forecast for first quarter profit that fell short of estimates. And then one of the stocks that's actually been performing very well is Coinbase, up for 5 straight days now. It's up 50% over this stretch now. It's up 3% here on the day, setting up for it's going to be the strongest weekly performance that it's had as a public company. She went out. Kathy Wood has also been buying into this as well. Her latest daily summary showing about 52,000 shares were bought on Thursday. All right.
Amazing.
It is amazing.
How much is it down from its highs?
Yeah.
It also got downgraded by Bank of America this week.
Yeah.
Wow, what a rip.
Yeah, we'll see. Interesting to see here, but you put it all together, and I guess what do you get? You get a pretty decent week here, actually, for markets in the U.S., but we got to point out the outperformance, and I don't want to keep harping on this, but there's been significant outperformance by non-U.S. stocks now for really the last couple of months. You've been talking so much, Carol, of course, about what's been going on in China. I was looking at the differential here. It's something like if you just peg it back, say, on 2 months, which is really when that China rally rally started to take off, it's like an 8-to-1 differential on a percentage point basis between what your return would have been on mainland Chinese stocks versus what you got in the U.S. And I think for Hong Kong stocks, it's even higher. It's like 20-to-1 or something like that.
Yeah, that's pretty significant. All right. Right now we know a big part of the narrative here in the United States is recession, no recession, little recession, soft landing. Everybody continues to weigh in, and that includes Larry Summers, former U.S. Treasury Secretary, catching up with David Weston for Wall Street Week. And he, I have to say, is staying with his recession forecast. It's not necessarily an upbeat one. Here it is.
One has to be careful of false dawns. And if you think about it, the good news was inflation running in the 6s, and that's still inconceivably high by the standards of 2 or 3 years ago. So I would stick with my view that a recession this year is more likely than not.
All right, of course, that's the former Treasury Secretary of the United States, Larry Summers. What?
Well, I was going to say, I mean, to this point there, I mean, and even though some people are backing off those recession calls, some are sticking with it. And we were talking a little bit earlier, the CIO over at Goldman Sachs wealth management business, they kind of had an interesting note out basically saying that, yes, a recession is going to come here, but that doesn't necessarily mean it's going to be bad for stocks. And they're making the case here that stocks still have a lot of upside potential. I think they're pegging it something like a 12% gain for the full year based off where we are today. And that includes even pricing in that recession.
All right, couple of things, and Tim and I have been talking about that. First of all, yeah, U.S. consumer sentiment, some numbers today, they look pretty upbeat. And in the meantime, there are a couple stories in the Bloomberg. Germany recession fears are easing. UK economy grows unexpectedly, so Britain may now avoid a recession. It's interesting to start seeing some momentum, if you will, especially as China continues to open. That makes me think, could it be potentially much more brighter in 2023?
Yeah, I mean, and I think also we have to take into account what we heard from the CEOs of the 4 big banks that reported earlier today. They weren't necessarily warning of a huge recession or, troubling times ahead. We didn't hear the word hurricane from Jamie Dimon this time, which I think some people took away as a pretty good sign. So, yeah, I mean, I think the theme of the week or the last couple of weeks has been it might not be as bad as we had previously thought.
Yeah, it does feel like some of the urgency has come out of the worst case scenario calls, especially when it comes to a recession. And that comes back to that point on whether the valuation reset, whether we've already priced in a lot of this bad news. And then you have the fundamentals maybe looking a little bit brighter. Maybe the worst really is behind us.
Yeah, and you still, I mean, in fairness, there's still a lot of strategists out there still kind of holding on to this idea that there is some pain ahead. I do think it's interesting, though. I mean, we were talking yesterday about the VIX. I mean, vol has just kind of disappeared right now, at least the expectations for the next 30 days or so here, not only in the equity market, but also the volatility in the bond market has come down really significantly. And we know that was a big driver of just total cross-asset volatility last year.
Okay, so the next thing for us to watch for, of course, a couple more big banks reporting on Tuesday, and then, of course, earnings continuing throughout the week, and what we hear from companies about how the consumer's doing and how their sales have been.
Hey,
and
just
Davos. We got Davos.
We have Davos. We also have a lot more earnings. Hey, just quickly crossing, Mr. Peltz saying he's gotten expressions of support for his seat on the Disney board, trying receiving inquiries, messages from Disney investors. So this is going to continue to be a story between the activist investor and Disney going forward. All right, that's a wrap. We'll be back in less than an hour's time. We'll continue our cross-platform coverage, radio, TV, YouTube, and Bloomberg Quick Take. We're going to count you down to the close on this Friday, the 13th. We'll be back at 4 p.m. Wall Street time. Off its lows of the session. It was down nearly 6.5% at its lows today. But we know the big story, Tim. They are continuing to cut prices.
Yeah, in the U.S., major European markets, and the car makers' latest efforts to stoke demand after several quarters of disappointing deliveries. Investors in Tesla obviously not happy about this, concern over margins, but look what's happening to other car companies as well. Back to Tesla, though, shares down roughly 60% since late September, Carol. So what the heck is going on?
All right, let's get to it. Bloomberg's Sean O'Kane is our EV reporter with us via Zoom in Austin, Texas. And then, of course, right here in our Bloomberg Interactive Broker studio with Ed Ludlow. He's the co-host of Bloomberg Technology on Bloomberg TV. And so, Ed, I want to start with you.
Sure.
Another round of price cuts. So put it in perspective for us.
Yeah, look, there's significant price cuts, particularly in North America and the US. You know, the Model Y is where we see them show up more. 20% price cut, you know, on the lower end Model Y, which is the kind of more chubby, chunky SUV-like car. You know, that Tim's smirking at me for our global audience because he knows it's not really an SUV. And then, you know, the headline in the Bloomberg story is up to $21,000 off the more.
That's real.
I mean, that's real. You know, we thought this would happen. You know, at least the sell-siders did, investors did. And then you look at the reaction in the stock. The stock, I mean, we paired much of the decline of earlier in the session, but is there a demand problem for Tesla? Well, this is kind of the final nail in the coffin of that debate. That said, this is about supply-demand balance. The inner Tom Keene economist in me is kind of tying his bow tie and thinking, well, cutting prices is a lever, right? If you want to find some demand, cut prices. The average selling price of a Tesla was super high, not affordable for most people. Does this now make it more affordable?
And I wonder, is it an economic move because things are slowing down, although we just talked about upbeat consumer sentiment, or is it just the market is more competitive? So if I'm going to play with the others, I've got to do something to, as you said, move the lever.
Well, look, some of the sell-siders cut their price targets, you know, downgraded the stock to sell because they see this as bearish, right? There is a demand problem. The other way of looking at it is that it's just a rebalancing of the supply-demand equation. You know, by cutting those prices, you find a pocket of demand, particularly in North America, where the consumer is under some duress from inflation and a slowdown in the economy. But they're doing this in Europe, and they did it in China. And there are lots of reasons for why they did it in China, right? A competitive landscape.
Really competitive landscape.
You know, in China, the government has removed government-installed incentive, or at least pared them back, you know, and so there are lots of reasons for it. The point being is that Tesla is using a tool at its disposal.
Yeah.
There are arguments on both sides of that bull-bear divide.
What's interesting to me, and Sean O'Kane, come on in here and give us our view from when it comes to other EVs and competitors here, because it's not just Tesla that's taking a hit today. We got Ford down 5.4%, GM down 5% right now. You got Rivian earlier was down as much as 7%. Sean, to the competition question, but also to the, like, you know, why are we seeing this reaction across the industry question? Can you answer those for us?
I mean, the competition question is really interesting. And Carol, you mentioned, like, in China, there's actually just far more direct competition for Tesla, which is why I think we've seen them be so much more aggressive with their pricing changes there, although they do change the prices here a lot in the United States. I don't think there's as much direct competition yet here, especially in some of these segments that Tesla plays in, which is why we've seen them just this week sort of cross over into essentially the leading, you know, quote unquote luxury automaker. And so I think the thing to watch is Ford seems maybe most particularly caught out by this in the sense that the Mustang Mach-E is probably like one of the most direct competitors to the Model Y, and is also in that sort of weird limbo that the Model Y 5-seater was just in before this price cut, where it was not going to be eligible for the IRA incentive for SUVs, and it was going to be, they were going to have to do some price adjusting to get it back under the level for non-SUVs, which now Tesla has done. And the Ford Mustang Mach-E is in this space where they're going to either have to cut a huge chunk off that MSRP, which I don't think Ford will do, to be able to compete more directly on cost with the Model Y. The thing that Ford has going for it right now is that Ford's still very much production constrained on the Mustang Mach-E, which was sort of the plan all along. So they actually have a lot more demand that they can kind of tap into, even if that price doesn't move much.
Sean, so do you just see this, again, going back to, I guess what I'm trying to understand, is it just a slowdown in the overall car market, at least in the U.S. here? Like you say, China's a different beast here in terms of the EV market and the competition. But is it just a reset, like the Bloomberg Business Week this week, when it looks at the used car sales? I mean, that's going through a major reset coming off of the pandemic. Is the same story for just kind of the auto market overall? It's not everybody's scrambling out there to buy a car anymore, like they were during the pandemic. So is it just a reset kind of back to more normal things? And that's also what we're seeing play out to some extent with Tesla.
I think that's driving a lot of this. And I think what's really important to always remember when you're thinking about Tesla and thinking about demand and whether or not demand's fully falling off or however you want to categorize it, is think back to what Ed just said about sort of like dialing the balance right. What's important to remember is that Tesla's actually just still always growing quarter over quarter and year over year at this point. And their sort of goal is to continue growing until they're up at the level of some of the major automakers. And so we're not really ever talking about, even when they missed coming out of Q4 and they delivered far fewer than people expected, around 400,000 cars. That's not like down quarter over quarter. We're talking about just sort of off the mark that they were guiding the market, and off that growth trajectory that Elon Musk pretty clearly wants of about 50% growth year over year. So while it can feel quite drastic, especially in the face of 5-figure cuts like this, that are probably some of the biggest we've ever really seen from Tesla stateside, it's important to remember that it really is kind of about that balance. And we were thinking a lot today as we were trying to contextualize these cuts about a quote that Musk gave on a Twitter Spaces a couple days ago or a week ago or so, where he said basically, his bias is to try to grow Tesla as fast as it can without putting the company at risk. And they have a lot more room to play. This is a move they can really only make if they were as successful as they were over the last couple of years with the Model Y especially, and giving them a bigger cash buffer and giving them much bigger margins so that they can actually make this adjustment to respond to the macro trends that are happening that a year or two ago, maybe they wouldn't have been in the position to be able to do this.
Well, that's what I wanted to ask Ed about is, can we read into this as, Ed, and is any idea that prices for components have come down, costs have come down at all? Because we know those component prices over the last couple of years have gone up, and those natural resources as well have been under pressure.
I'm going to give a very boring answer. Carol's going to roll her eyes. You're going to roll her eyes. For me, the immediate reaction from the sell side is this is negative for the stock because this is bad for gross margins, right? Them having to cut prices. One reason is, yes, we have seen their raw materials costs and the cost of doing business, moving goods, and sources in the company this morning were telling me they lament the difficulty in that end of the year last year being able to move vehicles to customers. It was too expensive. They had to pay over the nose to get trailers. Tesla also has long-term contracts for raw materials as well, which kind of helps to offset that. So, at the end of the day, the market's reacting severely. This is still a stock that trades at 25 to 30 times forward 12-month earnings. I know people go, oh, come on,
tech company,
tell us something techie. No, market fundamentals are important. So there's a pullback. I'd also say you look at the severity and the decline in Ford today. Well, Ford is coming off 10 straight days of gains, its longest streak on record. It was well into overbought territory, RSI for Bloomberg users. There's a lot at play here. It isn't straightforward, and part of it is just market fundamentals, which we love.
Haven't we also seen a little bit of a pop in Tesla too, as of late?
Yeah, and well, actually, until today. Today's move takes us back into negative territory year to date, and yes, we're only 13 days into 2023, but
it feels like 3 months already.
You can see the cynic in me is coming alive this week.
Hey, join the crowd, baby. Hey, Sean, just got about 40 seconds left. Quickly, what's on your radar when it comes to Tesla?
The margins, obviously, as Ed mentioned, is the thing that a lot of people are going to be looking at when they report earnings later this month. I think something to think about, and that I'm sure we'll probably hear about from the company, is that, yes, this may give a short-term hit to margins, but the idea is if they can get more people in their cars, maybe they can upsell more people on some of the software, which is just almost pure margin. The other thing to think about is, again, growth with Tesla. What's their CapEx going to look like this year? We just reported this preliminary agreement nearing in Indonesia for a factory there. Like, what are all of these things going to do for how they project how much they're going to spend this year? And how does that tie into some of these other